Very good volume. Yeah.
Good morning. Welcome to Widener. On behalf of the Dean, the faculty, and the staff of Widener University School of Law, I'm pleased to welcome everybody to this 44th annual, if I did my math correctly, Delaware Tax Institute. My name is Nick Mercay, and I'm associate professor here. And this institute has a long and distinguished history of collaboration and educational exchange between attorneys, accountants, and insurance and financial services professionals, so we welcome all of you. I particularly want to thank the people who make this institute possible every year, and we frequently put their names in the materials, but I thought it'd be nice this year to introduce them, and they're probably not all here, but we have a really phenomenal volunteer planning committee, some the members of which have been on the planning committee for decades, and just contribute every year trying to figure out the program, find speakers, and they do all of that just in the name of professionalism. So I just wanted to quickly recognize them. William Denny, just if you can just stand and just wave real quick. Jack Arneski, who's probably not here, I haven't seen him yet. Peter Gordon. Jerry Grossman. Thanks, Jerry. Jennifer Noel. Tom Pulsifer. Kathy Schultz, right down here. Don Sparks. Ken Stewart. Leo Strine. And Norris Wright. So Widener wants to specifically thank these members of the community who really give lots of time and talent to putting this institute together. And of course, I would be remiss if I didn't thank our CLE and Special Programs Coordinator, Connie Sweeney, who's standing right up there, who you all have met and emailed. So thank you, Connie. Due to their hard work, this institute brings together today leading tax attorneys, CPAs, financial service professionals in Delaware, Pennsylvania, New Jersey, and surrounding areas. Maya MacGuineas, who's going to be our distinguished keynote speaker today, is coming from Washington, D.C., and is going to educate and inform you on the intersections of federal budget reform, pretty much the mess in Washington, and how tax policy, potentially reform, can play into that. We have excellent panels on tax planning in times of transition, specifically under the 2010 Tax Act, business tax planning, captive insurance companies, and the changing landscape of officers' fiduciary duties. So it should be a really well-packed day. So I know that you'll be educated and informed by these impressive professionals. And once again, the Dean Linda Ammons, who cannot be with us today, asked me to extend her gratitude and welcome to Widener. So we'll get the program started.
Thank you, Nick, and thank you all for coming and taking your time to be here today. It's wonderful to see new faces and returning faces. I'm getting ready for Thanksgiving, and I was wondering how many of you are having Thanksgiving at your house? How many of you are going to have 50% of the people at your table 65 and older? Yeah, I mean, you laugh, but guess what? You know, this is coming. I think everyone's heard this statistic about now the baby boomers are turning 65, and every 8 seconds another person is turning 65. Well, I just heard like a more staggering statistic that by 2050, 10% of our population is going to be in their 90s. That's pretty crazy. So when we do this again, you know, in another 20, 30 years, you know, that probably most people will keep their hands up, you know. So that's pretty crazy. I wanted to just talk about, I just attended the AICPA National Tax Conference, November 7th and 8th, and I wanted to just bring a few highlights from that to you. The first session always is the legislative update. So naturally, you would think, you know, the highlight of the update was the super committee and what's going on or not going on there. They're tasked with finding a way to reduce the deficit by $1.3 trillion in the next 10 years. And Although I don't know how they're going to do that, I just wanted to let you know that over the past 40 years, we've averaged 2.8% of gross domestic product deficit, and the average spending is 20.8%. The average revenues are 18%. They also shared a list of the top 10 expenditures by the Joint Taxation Committee, and the top 3 are the exclusion for employer-provided health care, mortgage interest deduction, and reduced rates for capital gains and dividends. Well, we know that the health care now is required to be reported on your W-2. Well, that's a first step. Right now, it's not taxable, but at least they're getting a better idea of how much money they're losing in revenue. So who knows where that's going to go. Mortgage interest deduction, we know that's already capped at $1 million for original debt and $100,000 for home equity loans. And then the capital gains rate, of course, that's a Bush cut that's scheduled to expire unless they extend it. They also touched on value-added tax. They put a map of the globe up there, and except for Greenland, we're really standing out like a real sore thumb. It's basically us, Greenland, most of the Middle East, and 3 countries out of the 54 countries in Africa. So there's, it looks like value-added tax is something that's coming. So be prepared for that to show up soon. Also, Commissioner Schulman was there, and he spoke about what they're doing and what their initiatives are. They're sending letters to taxpayers. They're questioning Schedule A, Schedule E, and Schedule C, and also the Earned Income Tax Credit. Those are the big expenditures that they're focusing on. They're also sending letters to preparers that are under scrutiny, suggesting that they do some more studying on certain areas where they're finding inadequacies in the tax returns that they're preparing. They're continuing to visit these taxpayers under scrutiny. They're having visitation to the offices, and they're also sending letters to preparers that do not have PTINs or preparer taxpayer identification numbers, because that was mandatory as of 2010, and that's an annual thing that you need to continue to update your PTIN number. So that was just a little bit, and now I want to introduce our speakers here. Brian Menzel is a senior tax manager at Parente Beard. He's got more than 25 years of combined public and private experience in the areas of accounting and taxation. His clients include asset management companies, trust companies, investment partnerships, real estate developers, small to mid-sized businesses, and high net worth individuals. He's responsible for providing federal and state income tax minimization planning ideas and compliance service to his clients. And I just wanted to mention, because I know that probably a lot of you arrived here before the bios came out, so I just thought I would mention to you that they do have them up there, so if you want to have the little packet of bios, please feel free to pick them up. I'm sure that they're out there now. So, Brian,
Thank
you.
Yeah, I think I will stand up.
Okay. I think this works too.
Okay. Can everyone hear me? Okay. It's just like school, everyone's up in the back. Today I wanted to talk a little bit about just a few things that are happening this year and a few things that we may want to be looking out for things are, you know, pretty certain for what's going on this year, maybe next year, but 2013, you know, they're going to reshuffle the deck and who knows what's going to happen. So, but there are a few new things that have come out this year and a few things we probably want to take advantage of based on the current tax rates. So the first thing I want to talk to you about is this year, the Form 1099-B has been revised. And I know a lot of the major brokerage houses are spending an enormous amount of time to get into compliance with this. And it's probably going to be a 2-year program because with the 1099-B, there's also a new Form 8949 that's going to be included with your tax return. That's for sales and other dispositions of capital assets. It's filed with Schedule D, and it includes information that was previously on Schedule D. Schedule D is now almost a summary form, and the 8949 is going to support that. And the 8949 replaces the D1 that we used to use. And effective for stock acquired after 2010, brokers have to provide more information than what they used to. A lot of them have already been providing this, but what they have to provide now is the date of acquisition of the stock, cost or other basis, amount of loss due to wash sales, whether gain or loss is long-term or short-term, and whether the stock sold as a non-covered security. This could be a stock sale resulting from a stock dividend or a stock split. In 2012, they have to start reporting gains and losses on mutual funds and also stock acquired through dividend reinvestment. This is the way the new Schedule D is going to look. And as you can see, the short-term portion of it is just really a summary of the 8949. But on your 8949, there's 3 boxes up there. Box A is for short-term gains and losses from a 1099-B that shows the basis of the stock. There's also a box B for short-term gains and losses for a 1099-B that doesn't show your gains and losses. And then box C is for short-term gains and losses where no 1099-B was received. So theoretically, you could be including 68949 because you can only report, you can only use 1 box per 8949. So you could actually have 6 8949s attached to your Schedule D. And you look up, there's also an adjustment on the 8949 for if you get a gain loss statement and it doesn't actually agree with the actual, there's a reconciliation now in the 8949. And you go to the second column where the code is, there's going to be various codes that you have to insert, like if you didn't get a stock basis and the stock basis was incorrect. And then in the column G, that's where you show the adjustment. But, and this is a, this is the new 1099-B, and you can see there's boxes for short-term and long-term gains and losses, wash sales. So there's becoming more and more information being provided on the 1099-B this year than what there used to be. And you're still going to be able to, if you e-file, you're still going to be able to attach brokerage statements to the Form 8453 in lieu of the 8949. So I know a lot of us that actually prepare tax returns, a lot of times you might have 30, 40 pages of transactions that you're trying to attach. So you can still do that when you file electronically. But I guess in all the years I've practiced, I think the IRS is probably coming down a little bit more on Schedule D than what they used to, because I've never really, knock on wood, but ever had a cost basis questioned in any tax returns are filed. So it looks like what they're trying to do is start to do more matching in this area. Also for 2011, there's still an exclusion for qualified charitable distributions from IRAs. This extends through 2011. And since this qualified charitable distributions was enacted so late, the IRS allowed taxpayers to treat a qualified charitable distribution made in January of 2011 as a distribution in 2010. Now, the only thing you need to be aware of is that you're going to get a 1099-R in 2011 that's going to show this distribution. So you have to basically report it both on 2010's tax return and in 2011. And also, if you're tracking your client's distributions, you have to realize that this 2011 now is the 2010 distribution. Non-business energy property credit. The credit has been reduced to 10% for qualified energy efficiency improvements. Basically, the credit went down. There's also on the 5695 that it now requires the taxpayer to provide the address of the principal residence for which the credit is claimed. And since the credit was higher in previous years, what you have to be aware of, most software is going to take care of this, but what you have to be aware of that if you put the credit in this year, if you've already taken the higher amount last year or in previous years, you're not going to be able to deduct it. Now, most softwares our software, tax prep software, tracks this, but if you get a new client or something like that, you just want to be aware that these credits are cumulative. And also, they've increased some of the energy efficiency standards for certain items, so you just need to be aware of that this year. Another area the IRS is really cracking down on is foreign investments. And we've had a lot of, I know our firm's been doing a lot of work with international clients to try to get them in compliance last year. And this year, there's a new Form 8938 that's going to be required if you have foreign investments. And basically the 89, if you're single, married, or if you're filing single, the threshold is if you have an investment that was more than $100,000 during the year or $50,000 at the end of the year, you're required to file Form 8938. If you're married filing joint, the threshold is if your investment was more than $200,000 during the year or $100,000 at the end of the year, you have to disclose your investment, this foreign investment, on the Form 8938. And on the 8938, I think it's the Part 3, you also have to trace the income from that foreign investment to your 1040. And so there's a reconciliation there where you basically, if you have interest, dividend from this foreign investment, you show where that's being reported on your 1040. Now, many individuals are also going to have to file both the FBAR and the Form 8938. The 8938 doesn't take the place of the FBAR rules. Now, the 8938 is filed with the tax return, whereas the FBAR reporting is a separate form sent in separately with a separate due date. The requirement to file 8938, right now, it just applies to individual taxpayers, but the IRS anticipates issuing regulations that will require other entities to file the 8938. So it's probably just a matter of time before everyone's going to have to file this. And what you need, it's basically pretty much it's foreign financial accounts, stocks or securities issued by other than U.S. persons, or any interest in a foreign entity. So it also includes foreign mutual funds, foreign hedge funds, and foreign private equity funds. And the IRS has said that you don't have to get an appraisal if you have a foreign investment. You can use, a good faith estimate to come up with the value. They've also said there's also, for non-compliant, there's a penalty of up to $10,000. So it's fairly severe to not comply with this. Another thing new this year is the merchant card and third-party payment information reporting. Banks and merchant services will now have to report annual gross payments processed by credit or debit cards to the IRS and to merchants. And what's going to be used is a Form 1099-K. In the Form 1099-K, gross receipts are what's going to be reported. And I know a lot of probably smaller taxpayers, when they report their gross receipts from credit card receipts, a lot of them are probably just reporting the net amount they receive from the bank. What they have to do now is there's a reconciliation between if you have $100 on a 1099-K, but you only received 80 because of some type of holdback or an adjustment, or if someone had a debit card and they went to the store, charged $100, but only was $80 in merchandise and got $20 back. There's going to be a lot of reconciliation on this, and a lot of your smaller clients are probably when you get their tax work, are going to show just the net amount they received as their gross receipts this year. And so what you're going to have to do is reconcile that 1099-K gross amount to the amount that they're actually reporting. And backup withholding has been postponed until 2013. Backup withholding could be a serious issue for some taxpayers if they're delinquent on other taxes or something like that, and they're subject to backup withholding on this on the receipts. It could be a significant cash flow drain if backup withholding was imposed upon them. And there's a reconciliation on the tax forms this year on Schedule C, Schedule E, Schedule F, the 1065, the 1120, and the 1120S all have disclosure of the 1099-K gross proceeds and the reconciliation of what you're actually putting on your tax return. So it's all going to take a little bit more work this year. As I was preparing for this program, I was looking at, kind of looking around. There's not a whole lot of change this year, but I came across a couple things I thought I would also throw in. And one was the Barron's article on how the IRS is probing the rich. And the audit rate for the general population is 1.1%. For those making more than $1 million, it's 8.4%. But for those making more than $10 million, it's 18.4%. What the IRS is doing is they're ramping up a global high wealth industry unit. They're bringing together more than just an agent. They're bringing together a group of people that have expertise in various areas, because what they understand is that a lot of high net worth individuals, a lot of their income comes from other types of investments, from other types of businesses, and so you can't just look at the 1040, you have to also look at what else they're invested in. And I haven't seen this yet with any of our clients, but when you think of an 8.4% rate, it's probably just a matter of time. And a couple things that they mentioned that could result in an audit. What they're doing is they're going to county, they're going and checking county property records for transfers to see if gift tax returns have been filed. They're also looking at passive losses, and what they're looking at is, are they being classified right on the tax return? In other words, someone's got passive losses and they've got another entity, and maybe it's not passive but it's creating income. Are they characterizing that as passive income? And so they're looking at that. They're also looking at the amount of interest being deducted for home loans. This day and time, probably you've got $1 million in mortgage interest, $100,000 in home equity. You know, if you're probably over $70,000, it would seem like if you were, you know, if you're reporting more than $70,000 probably in home mortgage interest, you know, it may be something they would take a look at, because that's at about a, you know, 6.5% rate. They're also cross-checking taxpayers' reported income with their credit cards. If their credit cards are showing high charges but the income doesn't match it, it's one of the things they're checking. So it's probably a good thing to, and also foreign income. And they're basically going where the money is. They know that, you know, if you've got a high net worth individual, they pay there's a lot of tax paid, and so there's a lot of opportunity for adjustments. There's also an increased focus on S corporations' reasonable compensation. A recent GAO study reported that 13% of S corporations paid inadequate wages to shareholders. This is, you know, at one time, S corporations, smaller ones, weren't paying any wages. You know, courts have definitely just, you know, decided that, you know, this, you know, there's no taxpayer, I don't think, has hardly prevailed on this in this issue. But also, on the other side of it, you've got someone, maybe it's making the S corporation is generating $10 million in income. Maybe their salary is $300,000–400,000. Basically, your issue then is your Medicare tax, because when you talk about $10–20 million, it's a significant number. And the IRS has, there's been quite a few court cases on reasonable compensation for S corporations, and in 2008, the IRS came out with a fact sheet. It's FS 2008-25, where they kind of listed some of the factors that are used to determine reasonable compensation. And reasonable compensation is based on, you know, really still on facts and circumstances. Some of the things they mentioned were the shareholders' training, experience, time and effort devoted, payments to other employees, and payment of comparable businesses. But they also, in this survey, said that IRS examiners found that due to the difficulty of determining reasonable compensation, they tended to pursue only the most egregious cases. So I think when you're working with an S corporation shareholder, as long as you keep the compensation reasonable compared in consideration with the, you know, are there other assets that are generating the income, I think you're probably going to be all right. It's those ones that are not, are just out of the ballpark, one way or the other.
Hey, Brian, I mean, are you saying you think that that's going to be just an increased litigation focus, or do you think that is there any possibility of regulations in this area?
Well, yeah, there has been, there was talk about it, a year or two ago, about having, all the income subject to payroll tax, and they backed off of that. There's also been regulations in LLCs. I think there were proposed regs that came out years ago about the amount of self-employment tax that an LLC member could possibly be subject to, but they pulled those proposed regs. So it's out there. If you're looking for money, this is one place to find additional money.
Right. The inequity in the treatment between LLCs and partnerships versus S corporations. I mean, it's sad that this factor often factors into the decision as to what entity to form.
Yeah, because I think tradition. I guess historically, for the last maybe 10 years, what the IRS has been trying, or Congress has been trying to do, is kind of equal the playing field.
Exactly.
So you really didn't form one entity over another for tax reasons. But this still, if your S corporation is making a lot of money, there's still some dollars to be saved there. This is something we've got to the end of this year. It's bonus depreciation, 100% bonus depreciation for qualified property put in service between September 9th, 2010 and December 31st, 2011. Because in 2012, bonus depreciation reduces to 50%. Now, what's subject to it is qualified makers property with a recovery period of 20 years or less, and also includes qualified leasehold improvement property. Now, for bonus depreciation, it has to be new property. For 179, you can either have new or used property. And in 2011, Rev Proc 2011-26 addressed self-constructed property, and it was taxpayer favorable, but it also talked about when that self-constructed property is acquired when you begin construction or manufacturing. So basically, if you've got self-constructed property leasehold and you started, and the majority of the work was done before bonus depreciation came in, even if you put it in service after that date, it's when that property was started. Now, there's a de minimis rule that if you've only incurred 10% of the cost of the property, then it's deemed, and you did the rest of the work after the enactment date, you're all right. There's also a component provision in there that you can still carve out components, even though the majority of the property doesn't qualify for 50% for 100% bonus depreciation. You can take the components and maybe make them eligible for 100% bonus depreciation. Now, if you know you were working on someone's return and you later found out that you missed it, and if it's it could be significant dollars, and basically there's a couple ways to fix it. Well, the one way to fix it would be to file an amended return, but there's also a possibility, what you might want to consider if it's a lot of dollars and your client is really upset, maybe filing a 3115. There's a possibility of getting then 4-year spread on the adjustment, which would make it a little bit less painful after you've already told them that they could take a larger deduction than what they thought they could. For the qualified leasehold property, the IRS is really, this is something it's pretty liberal in what they allow you to take bonus depreciation on, much more than what it used to be. I mean, unless the improvements are structural to the building, enlargement to the building, something like that, you can pretty much qualify for the bonus depreciation. You also have the ability to expense assets up to $500,000 in 2011, as long as they're placed in service by December 31st. The good thing about this is it applies to both old and new assets. The $500,000 ceiling, though, is reduced dollar for dollar for assets acquired in excess of $2 million. But the good thing about, you can play with this because you still have the mid-quarter convention. And any assets that you use, that you take 179 deduction for, they're not included in the mid-quarter convention computation. And for 2011, businesses can elect to expense up to $250,000 of qualified real property placed in service during the year. Qualified real property is qualified leasehold improvement property, restaurant property, or qualified retail improvement property. I just want to mention a little bit about short sales. I know a lot of our clients have had difficulties, and there's a lot of debt forgiveness in the last year and this year also. But just want to be aware that real estate short sale involving recourse mortgages can trigger capital gains. And some of these gains may or may not be excludable under Section 121 rules, as well as debt discharge income when mortgage debt is forgiven. You just really have to go back and look at these rules, because there was a recent court, I think it was a court case on this, where a practitioner used the 121 exceptions for gain on the sale of property, and it all didn't qualify, and so they lost. When debt discharge income is triggered, what you want to look at also, there may be some relief under the 108 rules for insolvency, bankruptcy, or there's also an ability to adjust the basis of property in a partnership, adjust the basis down in other property rather than having to recognize that income. It's just something you need to be aware of. This year also, the executor of a decedent who died in 2010 can elect out of the estate tax rules for 2010 and use the modified carryover rules under Section 1022 for property acquired from a decedent dying in 2010. And basically, the modified carryover basis rules, and this is an area I don't really practice in that much, but anyway, the modified basis rules mean there's a carryover. Normally, you take the decedent's carryover basis plus any improvements, and if the property either goes to a Q-tip or goes to the spouse, you're able to take a $3 million step up. So if the basis of the property was $1 million, fair market value was $5 million, you could make the election to increase that basis by $3 million. If it's a non-spousal heir, the increase is $1.3 million. So it is an option, but this election has to be made on a Form 8939 by January 17th, 2012. Self-employed health insurance. Now payments for a child who has not reached the age of 27 by the end of the year qualifies even if not claimed as a dependent. And also Medicare Part B premiums can now count as part of the deduction. It was always in the IRS instructions up until last year that Medicare B was not eligible to be considered self-employment health insurance. The IRS just changed the instructions. I hadn't seen, and basically last year said you can do it. And so it's just one of those, we've got a few people that still have Schedule Cs or over the age where they're paying Medicare, and they are, we're now taking that deduction on there. I'm not sure if you can go back and amend or not. I haven't tried that. I don't know if any. I talked to a couple people. I mean, the instructions stated you couldn't do it back in prior years, and now you can do it. So I'm just not sure. Another thing you want to be careful with. I was at a seminar last year, and it used to be more prevalent, but sometimes you would see where if it was an S corporation, instead of putting the self-employed health insurance on the taxpayer's W-2, they would report it on the 1040 and then deduct it. And the instructor who was talking about this last year said the IRS said it has to go on the W-2, and if it didn't go on the W-2, they weren't allowing the deduction. So it's just, I don't see it as much anymore as I used to, but years ago, they weren't as much, some people weren't as much in compliant in reporting the self-employed health insurance on the W-2 as they should have been. This is just a small solo 401k plan, something that you do in year-end tax planning with clients. You want to think about. They can be, you can actually make elective deferrals, employer contributions under a 401k plan. So for certain income levels, you can actually defer more than you can from a profit-sharing plan or a SEP. So it's just kind of a planning idea that if you have a Schedule C or someone that's just got a one-person pension plan, take a look at this. There's not a lot of administrative work to a solo plan, and it's actually better for self-employed income between $162,500 and $245,000. So in that lower income level, you actually can benefit from looking at this solo 401k plan. We're in the 15% bracket for dividends right now. And it's probably a good idea to take a look at, if you've got S corporations that have EMP and or C corporations that have EMP, you may want to take a look at how to get that out for a variety of reasons. You might want to just, because the person wants to take advantage of the 15% tax rate, you could have a termination of the S election because of excessive passive investment income, or the corporation is subject to tax on excess net passive income, or the shareholder has a net operating loss. We've looked at a couple holding companies that, personal holding companies, C corporations, years old, and they had EMP, and they may have had stock, IBM stock or stock maybe 50 cents a share. And so what they're thinking about, what some of them have done, is actually made the S election. You have to plan, you're still subject to built-in gains tax, but what you have to do, you have to get that EMP out of there. Basically what you've got is portfolio income in it. And so there's a couple ways to get that EMP out of there. And you can make, and all these elections can be made by the extended due date of the return. You can make an election to bypass AAA and distribute A&P first. There's elections to forego previously taxed income. And then there's also, you can make a deemed dividend distribution. And a lot of times if you have a lot of accumulated EMP, what you may want to do is is make the deemed distribution. A deemed distribution means that the EMP comes out, shareholders pay tax on it, and then it's considered a capital contribution back. The only issue is the shareholders have to pay a tax on it, so we have to get enough money out to them for them to be able to pay the tax on the deemed distribution. Another area that we need to be aware of for year end is private companies, owners. You really have to pay attention and be in the forefront on all this tax change, because in 2013, owners of Schedule C's and flow-through entities could be paying as high as a 49% tax rate. And you really, before you're into this, you really need to do planning. I think we all need to do a lot more planning for the next year and a half. We don't really know what's coming, but we know it's probably not going to be good. You know, converting IRAs to Roths, accelerating capital gains, even thinking about selling, your business. I mean, you're talking about a 15% long-term capital gain rate, and I don't think we're ever going to see that again. Accelerating income, you got installment sales. You may want to not elect to do the installment sales. I remember back in '86, people had installment sales, and then the capital gains rate came up. They were collecting tax. They were paying tax at a much higher rate. Also, estate planning strategies. Right now, you've got gifting of $5 million, and with discounts of being able to take discounts, I mean, you get a lot of bang for your buck for the next year or two. And so you really need to be thinking of that. They've also increased penalties. Basically what they've done is double penalties for 1099s, for failure to file 1099s, W-2s. I think my time is running out.
Keep going.
There's only a couple other things. There's a few partnership changes. Schedule A's been eliminated. Now there's a new 1125A. There's a question on the form Schedule B for 5471. And there's also a disclosure now for information on loans to and from partners. And Schedule J on the 1120 and 1120S, there's now a couple parts, one for the tax computation and one for the payments and refundable credits. And there's a few other small changes, but nothing of any consequence. All right?
Thank you, Brian. Now we're all more well informed about 2011. And now I'd like to introduce Stan Stevenson. He is a director at Richards, Layton & Finger, and he focuses practice on federal income taxation and Delaware taxation, exempt organizations, employee benefits, and unclaimed property. He handles matters of Delaware income, franchise, utility, real estate transfer taxation, as well as estate and unclaimed property. He's a co-author of Limited Liability Companies, Legal Assets of Organization, Operation, and Dissolution, and he is the Delaware reporter for the Council on State Taxation, State and Local Tax Developments. He's a former chair of the Delaware State Bar Association Taxation Section. And Stan's going to tell us about some recent cases.
Thank you. My marketing director will be pleased. Good morning. As Kathy indicated, my name is Stan Stevenson, and when I'm not religiously updating my Facebook status or bemoaning the current state of the Philadelphia Eagles, I'm an attorney with the law firm of Richards, Layton & Finger. I've been asked to speak this morning about some interesting tax cases of the past year, or at least the ones that I could come up with the best jokes about. As always, my primary goal is to not jeopardize the break time. And I just want to say that I was honored to be asked to speak today on this Regis Philbin's last day. So, thank you. The first case in the outline is Mayo Foundation versus U.S., which is a U.S. Supreme Court case. Obviously, if you get a U.S. Supreme Court case, it's got to go first in the outline. The Mayo Foundation case is technically about whether medical residents are subject to FICA tax on their residency stipends. However, the more important part of the case is the Supreme Court's discussion on the appropriate standard to review a Treasury regulation, and thus it has importance to all areas of federal tax law. As seen on both ER and Gray's Anatomy, after medical school, medical residents typically work about 50 to 80 hours per week, but otherwise live fabulous lives and receive an annual stipend in about the $50,000 range. One of the exceptions from employment for FICA taxation is service performed by a student for a school, college, or university who is enrolled and regularly attending classes. Prior to 2005, the Treasury Department had construed this provision to exempt from taxation students whose work for their schools was an incident to and for the purpose of pursuing a study, which obviously was kind of a subjective test. However, in 2004, the Treasury Department issues a new regulation which basically said that if you work more than 40 hours per week, that work is not incident to and for the purpose of study, and thus you're out of luck and subject to FICA tax. After the regulation changes, the Mayo Foundation obviously doesn't like the regulation. They apply for a refund of FICA taxes and challenge the validity of the new Bright Line test that was issued. They win at the district court level, but lose at the appeals court, and the case gets taken by the Supreme Court. As the Treasury regulation clearly settled the issue, the only analysis that the Supreme Court could do related to whether the regulation was valid or not. The court discusses that basically they have two ways of proceeding. They could follow a basic level of review called the Chevron review, or they could perform a more detailed analysis. Under Chevron, it's basically a two-step process. The first step of the analysis is to decide whether the statute itself directly addressed the precise question at issue. In this case, the court concludes that it had not. And then in the case of other non-tax federal regulations under Chevron, the next step is for the court to decide whether the agency rule is arbitrary or capricious in substance or manifestly contrary to the statute. And obviously that's a pretty high standard to meet if you're going to try to overturn a regulation. Prior to the Mayo Foundation case, there had been some authority out there where the Supreme Court had seemed to consider a more flexible test when reviewing Treasury Department regulations, and they would have allowed for some more scrutiny and given consideration to such factors as the length of time that the regulation had been in effect, how contemporaneous it was, the issuance of that regulation was with the statute, the consistency of the positions of the department. In this case, obviously, you'd had a regulation that had existed for a long time, and then they changed it well after the statute had existed. And so Mayo Foundation was hoping for that more subjective level of scrutiny at the Supreme Court. Unfortunately, they didn't get it. The Supreme Court clarified the issue and decreed that review of tax regulations is based on the same standard that other federal regulations are reviewed, namely that basic two-step Chevron analysis. One, did the statute address the specific point? And if no, then is the regulation a reasonable interpretation of the statute? Thus, you know, they've clarified now that that's the level of review. They're only going to consider those two sort of basic steps, and it's going to be a tough road to hoe if you want to challenge the validity of a Treasury regulation. The next 6 cases in the outline, number 2 through 7, Beard, Burks, Grapevine Imports, Salmon Ranch, Intermountain, and Home Concrete. You never find any good tax cases named Smith anymore. These all generally deal with the exact same issue, and there are decisions at basically 6 different circuits on pretty much the exact same case. The issue under those cases is the availability of the extended 6-year period of limitations with regard to IRS assessments, where the taxpayer has overstated its basis in an item that it's sold. The cases reach different results and for different reasons. But it's interesting to discuss. I'm not going to discuss all of them. I'm going to try to weave a coherent fabric and tell the story from beginning to end, because it is kind of interesting. As I suspect you all know, Code Section 6501 provides the rule that in general, the IRS must assess an addition to tax within 3 years from the filing of the return. One of the exceptions to that 3-year statute of limitations appears in subsection E of 6501, which provides that if the taxpayer omits from gross income an amount properly includable there, and such amount is in excess of 25% of the amount of gross income actually stated in the return, then the service has 6 years rather than 3 years in which to assess additional tax. Accordingly, underlying all these issues, I think, are really what was meant by the word omit and what was meant by the word amount. As mentioned, the issue that is addressed is whether an overstatement of basis constitutes the omission of an amount of gross income to be within the 6501E 6-year statute of limitations, assuming, of course, that it results in an understatement of income equal to at least 25%, which, since we have 6 cases, obviously these all did. Like I said, rather than go through each case one by one, I'm going to try to tell a unified story. And I think the story starts way back in 1958. There's a U.S. Supreme Court case entitled Colony versus Commissioner. That case was actually interpreting a nearly identical provision of the 1939 Internal Revenue Code. And there, the Supreme Court essentially held that it recognized that the 39 code provision was ambiguous, but that in its view, the longer statute of limitations for assessment was meant for situations only where the taxpayer had omitted entirely the item or amount. Not reported the item, but kind of fudged the numbers a little bit. There had to be like no evidence of that item on the return. That's what they meant when they were providing for the 6-year statute of limitations. Their theory being that the longer period was necessary where there was no evidence because the IRS was at a special disadvantage to detect it since there was absolutely no evidence of it on the return. Two things that should be noted, and I'm noting them only because the cases seem to note them, is that the taxpayer in the Colony case was engaged in a trade or business, and thus there's quite a bit of discussion as to whether the holding of Colony is limited to situations where the taxpayer is engaged in a trade or business rather than just investment activities. Also, second, by the time Colony was decided, Congress had already tweaked the statutory provision, which currently exists as 6501E1A, by adding 2 additional subsections. The first subsection is consistent with the Colony decision in the case of trades or businesses, and the second subsection is that carve-out, which says that even if you omit the item, you can get the benefit of the shorter period of assessment if you disclose the item in a statement attached to the return. So the statutory provision changed a little bit, but essentially we're looking at the same issue. So now come forward about 50 years, and you get a whole bunch of cases on this somewhat basic issue related to overstatement of basis and whether it's the omission of an item. All of the cases that have worked their way through the circuit courts on this issue have come up in the context of a tax shelter transaction referred to as son of boss. Thanks to my good friends at Google and Wikipedia, I can tell you that the boss in son of boss stands for bond and option sales strategy. Now, as far as the feds know, I have never participated in a son of boss transaction. And so I will freely admit that I'm not exactly sure how they work, but I'm going to take a very rudimentary attempt to explain it as best I can. From what I can ascertain, these transactions, the taxpayer enters into a short sale arrangement where he buys U.S. Treasuries and then has an obligation to replace them, pursuant to the short sale contract. He then transfers the Treasuries to a pass-through entity and claims full outside basis for their value. However, what he doesn't do is he doesn't reduce the outside basis in his entity interests by the obligation to close the short position, and lo and behold, the short position is, that obligation is either transferred to the entity or at very least assumed by the entity, which of course closes that transaction almost immediately after receiving the Treasury securities. The reported result is that the taxpayer generates immediate losses far in excess of his actual economic loss, and then he can use those losses to offset taxable income for that year. However, unlike the taxpayer and colony, these are investment-type transactions rather than trade or business-type transactions, and that's why there's the discussion about whether the holding of colony was limited only in the case of trades or businesses. The taxpayers in these son-of-boss transactions report the transactions on their return. However, they, of course, report the sales using a substantially higher basis in the assets sold than the IRS was willing to accept. So in each case, as luck would have it, the IRS did not issue an assessment within 3 years of the filing of the return, but in each case, they did seem to get that notice of assessment out within 6 years. The taxpayers, of course, point to colony and argue that the IRS only had 3 years to assess because the item was not omitted entirely from the return as the transaction was reported. Obviously, the IRS disagrees, and we've got a dust-up. However, there is another interesting twist to this case. As at least some of the cases are working their way through the courts, the IRS and the Treasury Department decide that it would be a good idea to substantially alter the playing field in their favor with regard to the cases. And so in 2009, they issued temporary regulations, and then in 2010, final regulations that basically settle the issue in their favor. In other words, pursuant to the final regulations, even outside of the trade or business context, the overstatement of basis can constitute an omission from gross income, which is potentially able to trigger the 6-year statute of limitations. Now, with regard to these regulations, there become two issues, at least as they relate to the existing litigation. First, were they even valid? As noted earlier in Mayo Foundation case, under Chevron, before regulations are even permissible, the law has to be ambiguous. And so some of the taxpayers try to argue, the law's not ambiguous, you can't issue regulations on this. And then secondly, even if they're valid, are they applicable to the existing cases? Because the regulation wasn't issued until after the 3 years had expired on all these guys. So with regard to the effective date, and I give them credit for their creativity or chutzpah, or both, in the preamble, it indicates that the regulations are effective with respect to all taxable years to which the period for assessing the tax was open on or after September 24th, 2009. And they clarify that the taxable year is open if, among other things, it is the subject of any case pending before any court of competent jurisdiction in which a decision has not become final. And so this really is quite circular, and perhaps it offends others as much as it offends me, but what you had was a regulation that provided that it was applicable with respect to tax years for which the period of assessment remained open, but the substance of the regulation kept the period of assessment open. And so in essence, you applied the regulation to make sure that it applied. So, which was a neat little trick. And as we're going to find out, it actually convinced a fair amount of people that that was an appropriate way to handle things. And so, now you've got these taxpayers who find themselves in the middle of litigation, and now they're up against regulations which didn't exist when the case started, and they're obviously pointing out that this is a little circular, that you had to apply the regulation to determine whether it was applicable. And although that struck me as the correct analysis and quite unfair, as I'm about to go through the scoreboard on the cases, that actually carries the day in a fair amount of places. So with all of that lead up, let me just, I'll let you know how the 6 cases came out. Beard in the 7th Circuit. Beard is an IRS win. 7th Circuit finds that the colony decision does not control, and that a plain reading of the statutory provision means that in non-trade or business contexts, an inflation of basis does constitute an omission of income that may trigger the 6-year period of limitations. Since the court concluded that the service won on the statute, they didn't even get around to analyzing the regulation, so that was actually a nicer win for the IRS. Burks in the 5th Circuit. Burks is a taxpayer win. 5th Circuit rules that the colony analysis should apply, and accordingly you need a complete omission of an item, or they do fudge it a little bit by saying you can have a fundamental misstatement of the nature of an item reported to allow for the 6-year period of limitations to be available. 5th Circuit does look at the regs, says they're not applicable here because the statute is unambiguous in the taxpayer's favor, and thus the regulation is an unreasonable interpretation of settled law. So they actually went so far as to say the regulation is, not that the regulation doesn't apply because of a timing issue, but that the whole regulation is just not valid because this is an area that has been settled, and therefore you cannot issue regulations on it. Grapevine in the Federal Circuit. Federal Circuit rules for the IRS based on the new regulation, indicating that the regs satisfy the Chevron analysis as the statute is ambiguous and the regulations are a reasonable interpretation. Thus, the regulations are entitled to deference and the taxpayer loses. They also indicate, they do talk about the somewhat retroactive effect of the regulations, but indicate that they didn't believe that it constituted an abuse of discretion. Salmon Ranch in the 10th Circuit, pretty much parallels to the conclusion of the Federal Circuit in Grapevine. 10th Circuit in Salmon Ranch also rules in favor of the IRS, indicating that the new Treasury regulations are both applicable and entitled to deference. They apply the Chevron analysis, and they reject the taxpayer argument that the Colony case made the statute unambiguous. I actually thought that was kind of interesting, that what the taxpayer argued was the statute's not unambiguous because the Colony case settled it. But unfortunately, this later court does not agree that that's the appropriate way to look at things. They note that the Supreme Court in Colony acknowledged that the similar prior statutory provision was ambiguous, which is why that they had a case that they had a rule on. Thus, these regulations are permissible even if they're contrary to the prior conclusion of the Colony case. They did seem a little bit uneasy with the regulations, because they did take the time to say that although that they noted that the IRS's interpretation may not be their interpretation and may not be the only interpretation, that it was reasonable enough to be deserving of the deference that is normally afforded regulations that are issued by a federal department. And they also address but reject the issue that the regulation was being impermissibly retroactively applied. Intermountain in the D.C. Circuit, here again IRS prevails based on the new regulation. This is actually a really long opinion, but I have to admit it's quite well written, and this is probably the opinion that gives you the best summary of this entire issue. They conclude that the regulations are valid and entitled to deference, and then they settle the question. Once again, they do kind of note the somewhat circular nature of determining the application of a regulation by the substance of the very same regulation. But they feel that they do note that it's just an extraordinarily high standard to overturn the deference that's normally afforded a regulation. Home Concrete in the Fourth Circuit, here we actually have a taxpayer win, holding that the Colony squarely applies to the case. This one's actually, I thought, a little bit better for the taxpayer in that they did go further and they considered the new IRS regulation. Under its analysis, the regulation was not applicable to the case in hand because it could not apply retroactively to bring this case within the period of limitation. So this court was saying, okay, the reg's okay, and the reg's okay going forward, but you can't use the reg to reopen the period that closed for the period of law, or the period of time that existed prior to you issuing the reg. They did not go so far as to say, I mean, they seemed to think that the reg was probably not the best way to go forward, but they ruled basically that the reg was not applicable, not that it was invalid. So 6 cases decided in 2011 alone. You've got the 4th and 5th circuits in favor of the taxpayer, and the 7th, the D.C. Circuit, the 10th, and the Federal Circuit all in favor of the IRS. So what happens next? At the very end of September, the U.S. Supreme Court agreed to grant cert in the 4th Circuit's Home Concrete case, which, as I pointed out, was a taxpayer win, in order to resolve this split of authority. And so this issue, I fully suspect, will be settled during this year. And just as a matter of not that important information, the IRS actually just filed their brief on this case on Tuesday. I have not read it. And it was funny. There were a lot of one of the things you found. There was a lot of obviously this is a big issue, and there were a lot of amici briefs filed on this. And one of the things to sort of to keep in mind is that yes, all of these cases were tax shelter cases, and while people who were engaging in these transactions may have not been the our favorite taxpayers. I mean, this case, on a simple issue of basis, is going to have implications for everybody, and not just for the people who are engaging in the tax shelter transactions. And so, it's easy to kind of get caught up on, well, maybe these guys, really knew what they were doing, and we're trying to, be pigs at the trough with these transactions. But the outcome of this case is going to affect pretty much every taxpayer. I'm not recommending that you read the decisions of all 6 cases. I guess they're quite long. If I had to pick one, I would go with the D.C. Circuit's opinion in Intermountain, because I thought that one was the best at sort of outlining the entire history of the case. The only other one I'll note is the 7th Circuit's opinion in Beard, if only because as tax cases go, I thought the court had a fair degree of humor and sarcasm, which is I always appreciate when I'm reading a case. What am I doing on time? The next case that I thought I would mention is the Espinosa case. This case highlights the importance of documenting everything in writing, and it relates to the exclusion from taxable income for amounts received on account of personal physical injuries or physical sickness under Section 104. Ms. Espinosa was an employee of the Texas Health and Human Services Commission, and she sued them for discrimination based on gender, religion, national origin, as well as retaliation. The facts are not entirely clear, but during the course of the litigation, and at one point there are discussions, at least among her side, about approaching her former employer with a settlement proposal, which would be, and the number would be, in what they would view, would be sufficient to cover what she believed to be her medical bills for the physical and psychological ailments that were caused or exacerbated by the workplace discrimination. That number turns out to be $50,000. Settlement offer is communicated, and lo and behold, that's the amount which eventually is agreed upon by the parties. Around this time, both the attorney and for the plaintiff and her accountant inform her that the settlement will be tax-free based on 104, because they thought, you know, the way that they had worked up the numbers, they thought what they were doing was covering her medical expenses. However, the settlement agreement that actually ends up getting signed by the former employer and the plaintiff is silent as to what the $50,000 represents. It just says it's $50,000, and in exchange for that, we're going to release all claims. There's no allocation among claims, and there's no indication as to what, you know, why the payor is paying it. On her tax return, the plaintiff claims that the $50,000 is non-taxable pursuant to 104, as representing a settlement payment for injuries or sickness. IRS disagrees, and they go assess tax, interest, and penalties, including the accuracy-related penalty. Tax court agrees with the IRS, and the appeal goes to the 5th Circuit. The 5th Circuit looks at the settlement agreement and agrees with the tax court, noting that nothing in the agreement indicated that the payment is in settlement for medical costs and that there is no allocation among various claims. The 5th Circuit indicates that the understanding of the recipient is insufficient as to establish what the payment is for. Rather, it's the intent of the payor who's making the payment as to what claims he is releasing and why he's making the payment, which determines the origin of the claim and therefore the taxability of the amounts under 104, and unfortunately the taxpayer lost. Skipping ahead, on page 17 of the outline, there is the case Richard Nixon versus the Commissioner of the Internal Revenue. Now, let me just say that when I found out there was a tax case involving Richard Nixon, there was no way that was not going in the outline. However, as it turns out, apparently the name Richard Nixon is not as uncommon as I thought it might be. And so, as I'm about to explain, although Mr. Nixon is a tragic figure in his own right, as far as I have been able to determine, he is no relation to the former U.S. president. The story of Mr. Nixon's tax case, of course, starts with his divorce in 2002. Under the support order, although his ex-wife had primary physical custody of the children, the parties agreed that Mr. Nixon was allowed to claim the federal income tax dependency exemption and child tax credit for one of his children in every year and in every other year for the other minor child. Mr. Nixon does in fact claim those exemptions and credits on his return and attaches the required IRS Form 8332, Release of Claim to Exemption for Child of Divorced or Separated Parents. The only problem with that was that the form was not signed by his ex-wife. In fact, despite the clear requirement of the support order, she refused to sign the IRS Form 8332, and in fact, she claimed those exemptions and credits for herself on her return. Since the form wasn't properly executed, the IRS could only analyze whether Mr. Nixon was entitled to the dependency exemptions based on the facts. And since the children didn't reside with him for more than half the tax year, they weren't qualifying children for Mr. Nixon. And since Mr. Nixon couldn't substantiate that he had provided more than one half of their total support, they were not qualifying relatives either. So, thus, like a sad final verse to about half the country songs on my iPod, Mr. Nixon, despite the clear language of the support agreement and despite being current in his support obligations. I like the fact that the court took the time out to to make sure that he wasn't a bad guy and say that he was current in his support obligations. And despite gallantly representing himself pro se before the U.S. tax court, Mr. No relation to the former President Richard Nixon lost, receiving only a paragraph of sympathy from the tax court judge. One of my favorite cases of the year, and one of the most recent, is located on page 19 of the outline. It's Quarterman versus Commissioner. Quarterman is a very dangerous case in that it involves the court using an unparalleled amount of common sense in deciding the matter. I will say that this is the kind of a decision where you're going to want to sit down with a piece of paper and a pen, because it involves more dates than my 9th grade European history class. It involves with a taxpayer who's located in Germany. The IRS determines a deficiency and mails him a notice to Germany. And the first key fact of the matter is that although the IRS deficiency notice was dated May 4th, 2010, it was not in fact mailed until May 5th. And so I thought it was good that they caught that, because actually, days, in this case, that admission by the IRS, the fact that they didn't mail the notice on the day that it was dated, turns out to be critical. The general rule is that a taxpayer outside the U.S. has 150 days to file a petition in the tax court. In this case, the 150-day from May 5th was Saturday, October 2nd. See, if they actually mailed it on October 4th, it would have been Friday, October 1st. And so by the IRS missing it by a day, he actually got 3 extra days, because he gets till Monday, October 4th to file his petition with the tax court. And if things were only so simple, but of course the taxpayer in Germany does not successfully get his petition to the tax court on Monday, October 4th, but he does get it there on Tuesday, October 5th, 1 day after the deadline. However, the taxpayer had in fact mailed the petition, obviously, well in advance of the deadline. In fact, he'd mailed it on September 27th. However, he had mailed it from Germany, and so it only had a postmark from the German mail system and not a U.S. postmark, and thus was not entitled to the benefit of the mailbox rule. So, the IRS, being the mean-spirited people that they are, file a motion to dismiss the petition for lack of jurisdiction on the theory that the petition was not timely filed with the U.S. tax court. However, the court saves the day. In deciding for the taxpayer, the court notes that where the U.S. postmark is illegible or just missing, that you can look at extrinsic evidence to determine when the letter actually entered the U.S. Postal Service. And we had some nice facts for the taxpayer. The court noted that the tax court intake office indicated that the petition was received at 8:04 a.m. on the morning of Tuesday, October 5th. And so, knowing what they knew about the U.S. Postal Service, they knew that that petition did not arrive in the United States Postal Service on Tuesday, October 5th, and get delivered by 8:04 on the same morning. And so the court stated that it followed perforce, and by the way, I had to look up the word perforce, that it was in the U.S. mail system by Monday, October 4th, since there was simply no way it could have gotten there and been delivered by 8:04 on the same day. And that seemed obviously true to me, and the petition was deemed to have been timely filed. And I have no idea whether he won or not, but he at least gets his day in court. Let's, how am I doing? I don't like 10 minutes. I'm going to skip to, I'll skip to the AT&T case back on page 7. I thought this case was worth mentioning just for the fact that it involved a taxpayer suing the IRS for a $500 million refund, which in government terms is equal to a lot of cruise missiles. In essence, the case is about whether amounts paid by the federal government and by state governments to AT&T in order to provide universal service should be considered income, which of course would be subject to tax, or they're considered non-taxable contributions to capital. It's the goal of the FCC and presumably these other state governments that universal services be provided, namely that consumers in all regions of the nation, including low-income consumers and those in rural way out in the middle of nowhere places and thus high-cost areas, I'm paraphrasing, should have access to telecommunications and information services that are reasonably comparable to those services provided in the obviously profitable urban areas, and that they should be available at rates that are reasonably comparable to those rates charged for similar services in those profitable, high-traffic urban areas. As you might expect, this is accomplished by imposing a tax on all of us, on all telecommunication services. They create a fund, then they make payments back to the service providers that provide services to the remote regions or the low-income regions. In general, my understanding is that the telecommunications providers pass along this tax to us, and then they remit it back to the fund. In calculating their taxable income, they recognize all the amounts they receive from their customers. They deduct the amounts that they pay back over to the fund. However, when they were getting payments back from the fund, AT&T was not taking those into income. They were treating them as capital contributions made by the governments. They were doing this pursuant to Code Section 118, which does contemplate that in certain circumstances, non-shareholders might make capital contributions, in most cases governments, might make capital contributions, and it's usually in the cases of public utilities. District court level, the government moves for summary judgment and that there's no material question of fact and that the payments were taxable income. AT&T appeals to the Fifth Circuit. Fifth Circuit affirms the decision of the district court indicating that whether a payment to a corporation by a non-shareholder is income or a capital contribution, it's controlled by the intention of the transferor, which from the government's point of view is great. They were on the other side of the courtroom. They said, of course it was our intention it would be taxable income. But the court says that with the transfer as a governmental entity, its intent may be manifested by the laws or regulations that authorize and effectuate the payment. And that there was apparently another case called CB&Q, which actually had a five-factor or five characteristic of a capital contribution description. And the Fifth Circuit basically looks at both of those types of tests and says AT&T loses under either one, so we don't even need to decide what the right test is. And they conclude that the payments what the government was compensating AT&T for with regard to the payments was for not charging the actual revenues that would make the remote service profitable, and therefore they were lost revenues and not, not contributions to the infrastructure of AT&T. Next case I'm going to talk about is K versus Commissioner on page 16. We have, in this case, we have 3 tax years at issue, 2000 through 2002, and you can kind of think about the economic environment in each of those years. It might be helpful to sort of understand what went wrong. Oddly enough, the case starts off by noting that the taxpayer had a degree in economics from San Diego State University and that he operated a seemingly profitable ball bearing manufacture and distribution business. However, as the taxpayer would have us all believe, the lure of the easy money and exciting lifestyle of a securities day trader enticed him to enter the trade or business of trading securities for his own account. And as always the case in these trader business cases, we have a dispute because, well, the taxpayer kind of stunk at day trading. And he generated 3 years' worth of steady losses. The IRS argued that he didn't trade enough to constitute a trader and thus was only an investor. And as a result, he was not eligible for the mark-to-market election he had made and not entitled to deduct his millions of, or several $100,000 worth of losses each year in excess of the $3,000. The court indicated that for a taxpayer to be a trader, the trading activity must be substantial, which means frequent, regular, and continuous enough to constitute a trader business. And in this case, kind of seemed like a lot to me because I'm not much of a player in this field, but the taxpayer had executed 313 trades in the first year, 172 trades in the second year, and 84 trades in the third year, but had done so on less than 15% of the trading days. And I guess although the court did not use the expression "not even close" in ruling against the taxpayer, I got the sense they were thinking it. So, what else do I got? All right, the last case I thought I would mention is and I'm not sure if I'm pronouncing this correctly, I'm going to call it Freda, F-R-E-D-A case on page 7 of the outline, mostly because the case involves Pizza Hut, and I find Pizza Hut to be delicious. At its core, the Freda case is an origin of the claim case relating to settlement proceeds received for misappropriating a trade secret. The facts of the case are as follows. Mr. Freda is a shareholder in an S corporation, C&F Packing Company, which was a supplier of sausage to Pizza Hut. And God love them, C&F apparently had developed some sort of special patented sausage packing process for producing really excellent sausage that Pizza Hut liked. So Pizza Hut wants to enter into a contract with C&F for sausage. However, the problem is that, you know, C&F is not big enough and I guess not national enough, and so they're not going to be able to fully satisfy Pizza Hut's needs for nationwide sausage, and so they're only going to be able to provide them with a small percentage of the sausage they're going to need for their pizzas. And so Pizza Hut negotiates for the right, and Pizza Hut says, I need a uniform product out here. I can't have a different sausage pizza in Minneapolis than in Los Angeles. And so they negotiate for the right to share this special process with some of Pizza Hut's other suppliers. C&F reluctantly agrees, but they do limit the number of people or the identity of the people with whom this process could be shared. And, you know, as luck would have it, Pizza Hut breaches the agreement, gives the secret to somebody else who wasn't on the approved list, and as it turns out, after that, Pizza Hut starts ordering a lot less sausage from C&F and a lot more sausage from the people that they shared the secret with. C&F wins a jury award against the other producer, and after some procedural issues, C&F ultimately settles with Pizza Hut for about $15 million. After deducting a heck of a lot of expenses, the C&F reports the remaining $6 million, the entire amount that they had left, as a long-term capital gain. Service challenges that classification, indicating that the payments were for lost profits, which would have been ordinary income. C&F tries to argue that the settlement amount was for money received for damage to their capital asset, namely the process, or alternatively, that what really happened was they sold the process to Pizza Hut. Or it was, their third alternative argument was that what they were being compensated for was the termination of the confidentiality agreement that they had executed with Pizza Hut. Seventh Circuit indicates that the taxability of the amounts received in settlement of the claim depends on the nature of the claim and the actual basis of recovery. And in this case, they would look to what the settlement payment was received in lieu of. And under that test and the applicable standard review, they concluded that the tax court did not err in holding that the taxpayers had failed to meet their burden to show that the settlement payment did not represent damages for lost profits rather than payments for the damage to their capital asset. And so they lost. And that's all I have.
Okay, thank you. And as you promised, record time. right in time for the break. So everyone, there's a 15-minute break, and be back here at 10:20.
Part of the presentation, and we're going to speak in the order listed in the program. Jocelyn Margolin Borofsky is going to begin with a discussion of federal estate tax case law developments in the past year. Jocelyn is a partner at Duane Morris, a graduate of the University of Pennsylvania Law School, and has an LLM in tax from New York University. Jocelyn, thank you.
Good morning, everybody. Can everybody hear me? If you didn't see this, I'm going to be speaking based on this outline. I do have 20 pages of case studies in your booklet.
I don't think I can hear you.
Oh, okay. How about this? Nope. Well, I'm like a mile away
We
from
may
this.
have to sit down.
Okay.
Maybe you have to lean over it.
Is that okay? Better? All right, so I'm going to be speaking off of this outline, which was on the table up there when you walked in case you want to take some notes. This year was a unique year for transfer tax cases. I've been covering this topic for 4 years, and this is really the first year where there were scarcely any family limited partnership cases. Instead, there were a number of valuation cases a couple of defined value cases, and a smattering of everything else. As to the defined value cases, those present an interesting planning opportunity because they work. And what I'm talking about is this. Let's say you have a client who has a hard-to-value asset, such as company stock in a closely held company. And your client wants to make a simultaneous gift of that stock to a family trust or a family member and a charity at the same time. The way the defined value clause cases work is that you would have your client transfer a set number of shares of stock, and I'm using stock as an example, let's say 1,000 shares of stock in an assignment document that sets forth the amount going to the trust and the amount going to charity by formula. And the formula would say something like this: I give 1,000 shares of stock to family trust and charity, and I give so many shares as equals a fixed dollar amount to the family trust, and the rest goes to charity. The trustee and the charity are going to get a valuation report that determines the price per share. And then there's the readjustment clause, which says that if this value is redetermined, the trustee, I still give the same dollar amount to my family trust, but then the trustee has to give an additional number of shares to the charity. The taxpayer will then take an additional income tax charitable deduction, so the taxpayer is not out of pocket. Now, as you might suspect, the service does not like these defined value clauses and has challenged them in a number of cases, but has largely lost. You might remember the Christensen case that came out a couple of years ago. The taxpayer won, and it was affirmed in the 8th Circuit. Then there was the Petter case, which came out a year or two ago. In the tax court, the taxpayer won. This year, the 9th Circuit affirmed in favor of the taxpayer. Also this year, we have the Hendricks case, and that is in the tax court. The court also found in favor of the taxpayer. But there are a couple of arguments that the service made in those cases, in Hendricks and in Petter, that I thought were worth mentioning. In Hendricks, the service argued that the transaction was not at arm's length and should be ignored, that the valuation clause should be ignored. And the implication was that the taxpayer had somehow manipulated the charity into its own tax advantage. But the facts actually went the other way. There, the taxpayer negotiated with a charity that was a large public charity that had an independent board of directors. It had its own attorney who had negotiated with the taxpayer and had also followed all of its own internal procedures. So based on those facts, the court concluded that this truly was an arm's length transaction. But it raises a question in the planning stages. If you have a client who's interested in doing this kind of transaction, what if your client wants to use a private foundation? Will that work? Well, it may work, but I just think you would have a much stronger position if you got audited if your client could be encouraged to use a public charity for making its donations. And maybe a donor-advised fund would be a good in-between compromise. In Petter, on appeal in the 9th Circuit, the service made an interesting argument regarding the income tax charitable deduction. It said that the taxpayer should not be able to get that income tax charitable deduction because it was subject to a condition precedent, namely that the charity wouldn't get those additional shares unless the value was audited. And that actually makes a lot of sense to me because, in fact, the charity, that's actually true. But the court didn't find in favor of that argument. Instead, the court applied a sort of relation back analysis, finding that the initial transfer document, because it provided a formula, whatever that per share value ended up being, it related back to the date of the transfer, and it was not a condition precedent. So these defined value clause cases involving a charity absolutely work. Now, I mentioned that there weren't a lot of family limited partnership cases, but there was one called the Turner case, and it was kind of a typical transaction. The decedent had formed a family limited partnership. He had a large holding in Regions Bank, and this was in the family for many years. and he put it in the family limited partnership. Now, under 2036, the service will typically come in and say there's been a retained interest, and the exception under 2036 is that the decedent transferred the property into the partnership in a bona fide sale for full and adequate consideration. Now, for several years now, the courts have held that in order to succeed on that, to prove that exception that there was a bona fide sale, the taxpayer has the burden of proving that the formation of the partnership was for a legitimate and significant non-tax purpose. Well, this decedent's estate had a few arguments trying to show a bona fide sale, and one of the main argument was that the decedent had wanted to effectuate a buy and hold policy. Now, this might sound familiar to some of you because there was a case with a local decedent called the Shutt case in which that very argument was successful. However, in Turner, the taxpayer really, the estate didn't have the facts on its side. It didn't have fabulous lawyering to support the outcome as they had in the Shutt case. I'm waving to my former mentor who was involved in the Shutt case. Anyway, they didn't have great lawyering. They didn't have documentation supporting the use of a buy and hold policy, and there was actually testimony showing that there was no buy and hold philosophy that they were trying to support. And then there were some other intra-family personal issues that they tried to raise as one of the purposes for forming this partnership, but again, the facts were not on their side. So next, the court turned to whether there was a retained interest, and again, bad facts abounded. And there was evidence that the decedent had treated this partnership as sort of his own property, and there had been disproportionate distributions. Those are all bad facts, and in the end, the property in the partnership was included in the decedent's gross estate with no discount. Now, there was a second part to the Turner case that actually went better for the taxpayer, and that involved a life insurance trust. During his lifetime, the decedent had paid the premiums directly to the insurance company, and the trustee had failed to send out crummy notice letters. So, of course, the service took the position that the transfers into the trust, the payment of those premiums, was not entitled to the gift tax annual exclusion. Well, the court looked at the trust agreement, which said that each withdrawal beneficiary was entitled to withdraw property from the trust that was transferred by gift, either an indirect gift or a direct gift. And based solely on the terms of the trust agreement, the court found in favor of the taxpayer. Now, this is a tax court memorandum decision. I wouldn't use it as the basis of planning, but it certainly could come in handy if you have an occasional client who hasn't sent out crummy notice letters. Now, there was another case this year, Coaxum versus Commissioner, that involved a life insurance policy, but that one didn't go so well for the taxpayer. As you may know, under Section 2042, if a decedent dies owning an interest in owning a life insurance policy, the proceeds are includable in the decedent's gross estate. Even if the decedent doesn't own the insurance policy or it's payable to someone else, if the decedent retains incidents of ownership in the policy, then the proceeds are still includable in the gross estate. And that's what happened in Coaxum. It's kind of a cautionary tale that if we are representing clients with life insurance, that we should make sure that the decedent doesn't retain any incidents of ownership. In that case, the decedent retained the right to change the beneficiary. And that's one of a number of incidents of ownership that could trigger the tax. Now, I mentioned that there were a number of valuation cases. I thought I'd run through them and give you a sense of what kind of discounts are being allowed this year. In the Gallagher case, that case involved the valuation of a publishing company in which the decedent owned a 15% interest. There, the court allowed a minority discount of 23% and a lack of marketability discount of 31%. Justina, that involved a valuation of a timber company in which the decedent owned a 41% interest. Well, that case, in order to explain what discounts were allowed, I have to set this up. Each expert in that case had employed 3 or 4 different methods of valuation and had weighted them. The court threw out everything except 2 methods of valuation. The court allowed the discounted cash flow method and the asset method. The asset method is basically a company's liquidation value. And it was a little bit shocking because there was no indication that this company would be sold, and the decedent's estate only owned a minority interest. But the court weighted the asset method 25% and then would not allow a minority discount on top of that because it said that weighting the asset value only 25% was in effect the minority discount, because the liquidation value of that company was 3 times as great as its going concern value. Now, as to the discounted cash flow method, the court did allow a discount for lack of marketability as to that portion of the valuation of 25%. The Mitchell case involved fractional interest discounts in 2 real properties, one a beachfront house and a ranch. And actually, the service and the taxpayer stipulated to those discounts, and the court approved the discounts. The case was really about the underlying value, but I thought it was interesting to note the discounts, the fractional interest discounts that were allowed in that case. Now, these 2 properties were owned 95% by the decedent's revocable trust and 5% by children's trusts. As to the 95% interest in those properties, the service stipulated and the court approved fractional interest discounts of 19% and 35% as to the beachfront and ranch properties, respectively. And that's for the 95% interest. As to the 5% interest, the fractional interest discounts that were allowed were 32% and 40% as to those 2 different properties. The Adler case also was a case about fractional interest discounts, but in that case, the discounts were not allowed. Now, the facts were kind of unusual. It involved a large ranch, and back in the 1960s, the decedent conveyed 20% undivided interests as tenants in common to each of his 5 children in that property, subject to his life estate. And as we all know, under Section 2036, that property had to come back into his gross estate because it was subject to his life estate. What the estate argued was that because the property passed in fractions when he died in those 20% interests, that each of those interests, the property should be valued with fractional interest discounts. The court said no. And the reasoning was that because the fractional interests were created at death, they came into being at death, the court would have to value the property as a whole. Had the fractional interests been established during the decedent's lifetime, then the discounts would have been available. The last valuation case that I thought I would mention is the Levy case. That one also I found kind of surprising. There, the taxpayer owned real estate in Texas, and during his lifetime, he had been trying to get a zoning change, and he had been holding out for a higher sale price with respect to that property on account of the zoning change, but he had been unsuccessful. He couldn't get the zoning change, and then he died. After he died, some part of the zoning change occurred, and the estate sold the property 2 years later. The court held that the post-death sale price, which occurred 2 years after the decedent died, was the date of death value. And the estate tried to argue that's not permissible because the zoning change was not foreseeable, and you can't use post-death information or facts unless they are foreseeable as of the date of death. Well, the court didn't buy it, and the court thought that it was foreseeable because the zoning change that the decedent had wanted was too big of a scheme, and a smaller zoning change actually was the zoning change that had been implemented. Now, as I mentioned, there were a lot of valuation cases, and rather than running through the facts of all those cases, that's not so useful because each of these valuation cases is very specific. But what I thought I'd like to do is highlight some of the trends that I saw in the cases this year that you could look out for when you are reviewing a valuation case for your own clients. So number one, hiring an expert with expertise in the specific subject area will work and oftentimes will work in favor of the taxpayer. So, for example, in the Mitchell case, there were 2 paintings, early American Western art, and the taxpayer splurged for an expert, valuation expert, who had expertise specifically in American Western artwork, and that was the valuation report that was respected in that case. Even though the other valuation expert had all the right initials after his name and belonged to all the right societies, the valuation expert with the specific expertise is the one who won the day for the taxpayer. Number 2, tax affecting. Well, let's say you have a going concern that's a C Corp. Valuation experts will often give a kind of discount to account for the fact that there are 2 levels of income tax on the C Corp interest. When you have a pass-through entity, you don't have that double layer of tax. And the trend is courts don't like to see tax affecting because they think it's double dipping. So if you happen to be reviewing a valuation of a pass-through entity, I would check with your valuation expert to make sure that they're not tax affecting anything, because it will draw an audit. Market comparables. Well, market comparables seem to work well in the context of real estate valuation, better than in the context of company valuations. But in the real estate situation, we have the Mitchell case that involved the beachfront and the ranch property. Closer is better. You had two experts, and they both used market comparables, but one expert used properties that were in the same valley area. The other expert used properties that were in the same county, and the property comparables that were in the same valley were held to be more reliable than the ones in the same county. Closer is better. In the area of business valuation, it's usually called the guideline company method. This has been lately the trend in these cases in Gallagher and Justina. The courts have rejected use of the guideline company method. And the reason is usually you just can't find similar companies to your subject company. The last point I'll leave you with is the use of restricted stock studies in the context of deriving the lack of marketability discount. Judge Halpern in the Gallagher case, his opinion was that you shouldn't use restricted stock studies to derive a lack of marketability discount where the stock is held for periods longer than 2 years. That was his opinion. In the Justina case, you had a different judge, Judge Morrison. Judge Morrison didn't have a problem with the use of restricted stock studies to derive the lack of marketability discount. He didn't like the pre-IPO studies because he thought that those studies overstated the lack of marketability discount. So that brings me to my conclusion and my larger point, which is it's hard to predict the outcome when you have a valuation case. And the trend has been that the courts are slicing and dicing these valuation reports and making up their own valuation. And so I think there's a lot of risk involved in going to court if your sole issue is valuation. Thank you.
Our next speaker is Scott Goodwin, of Morris Nichols. Scott has his JD from the University of Virginia Law School, and Scott is going to be talking about non-case law developments in estate planning.
All right, so if I speak in, okay, you can hear me, great. Richard ruined it for me. Stan Stevenson came up before we started and offered me $20 if I would introduce myself as Tom Pulsifer and then curse a lot. But I don't know any curse words, so, you know. And actually, I'm not even a poor man's Tom Pulsifer, so I'm a poor man's Tom Pulsifer, if that. So, as Richard said, I'll be talking about non-case law developments. Specifically, these would be like regulatory developments for the year. Unlike Jocelyn, I tried to think of sort of what would be a unifying thread for what I turned up, but they're just kind of all over the place. So, so I don't have a larger takeaway point, so I'm just going to pick out a certain number of them and try to focus on those. I would say that in the developments that I saw in the past year, there were a number of PLRs that concerned transactions involving Q-tip property, I saw a number of PLRs that involved Scrivener's errors. So I don't think of that as a trend. It's just kind of interesting. And then I would direct your attention to the back of my written materials. This is on points O and P. And I'm not going to talk about these because I figured that everybody at the Delaware Tax Institute would probably already be aware of the filing and penalty extensions for 2010 decedents and also the guidance about portability. If it's possible that you weren't aware of these things already, I'd direct your attention to the back of my outline, but I thought that that would probably already sort of be on everybody's minds, and so I'm not going to spend any time talking about that today. The first thing that I wanted to talk about is, this is in section B of my outline on page 4, and this is about decantings. And decantings is something that I actually do know a little bit about. We do quite a few of them in my line of work, and for those of you who aren't familiar with decantings, it's possible somebody in Delaware may not have heard of them. Under state statute, this was first enacted, I think, in New York and then Delaware, and now a number of states are adopting decanting statutes. If you have an irrevocable trust that's otherwise not amendable except through a court proceeding, if under the trust document, the trustee has the ability to invade principal, so they have either unfettered discretion to distribute trust principal to or among a class of beneficiaries or to a single beneficiary. Or it could be that the trustee has discretion to invade principal, but only subject to a HEM standard or some other kind of limiting standard. You take the logic of that, which is that the trustee has the ability to potentially distribute all of the trust outright. And what the decanting statute does is allow the trustee, instead of distributing that outright, they can also distribute it to another trust or in further trust, subject to certain limitations. And all of those limitations are sort of logical once you think about it being derived from the trustee's ability to distribute principal to this class of beneficiaries. So in a decanting transaction, the trustee, for example, couldn't decant to a trust that adds new beneficiaries. At least you can't do that under the Delaware statute. I don't know if that's possible under other state statutes. The trustee can distribute to just one of those beneficiaries. So say I set up a trust for my 4 children, and it's a pot trust, and the trustee can distribute to any of those 4. Well, the trustee could distribute to a new trust and could conceivably distribute all of that trust principal to just one of the children, which to me sounds like a recipe for a lawsuit. Or what's more common is the trustee can distribute or can decant to 4 separate trusts, maybe one trust for each of those children. So there's a lot of flexibility that you can have in decanting. Where we see it happen a lot is where the trust is maybe old and there's administrative provisions that people are no longer happy with, or they want to add an investment advisor provision, they want to add a new trustee appointment mechanism or things like that. And so often you won't mess with the beneficial provisions at all. You'll just decant to a new trust that has different administrative provisions, and so you're able to do that without going through the trouble of going to a court and collecting all the consents. Now, as a practical matter, we find that trustees don't like to do decantings unless you collect releases and consents from all of the beneficiaries who can virtually represent the more remote interests in the trust. But that's not a requirement for decanting. That's just something that the trustee likes to have. This is done through the trustee's inherent power in the document and under the state statute. So it's another way of tinkering with a trust. So it's interesting that in Rev Proc 2011-3, the IRS is aware of decantings, and they've put it on their temporary no-rule list. So this is in their no-rule list, the release every year. Section 5 is devoted to areas where they're temporarily not going to issue any private letter rulings until sort of further analysis, until they issue another Rev Rule or a Rev Proc or something like that. And specifically, what the IRS is not going to rule on is, and this is on page 4, they're not going to rule on whether distributions, whether a decanting that results in a change of beneficial interest is a distribution for which an income tax deduction is allowable, or whether that decanting should be included in the gross income of any person. So they're not going to rule on sort of income tax consequences of that. Also, whether a decanting that results in a change in beneficial interest is a gift under 2501, or whether it causes a loss of GST-exempt status or constitutes a taxable termination or taxable distribution under 2612. So income tax, gift tax, GST tax, the IRS is not going to rule on that, but you notice it says in each of those cases if the decanting results in a change in beneficial interest. So as I said earlier, if you're just going to do a decanting that's tinkering with the administrative provisions, then probably that's not going to be an issue to you. And I would wonder, at what point does it become a change in beneficial interest? So for example, if you have a pot trust and you decant to separate new trusts, does that change the beneficial interest? Well, probably, but I think that there's some ambiguity there. So it'll be interesting to see what comes down the pike for that. But that's the only thing that I wanted to talk about on that subject. So moving on, this is in subsection or section G. And I will say, I had every intention of preparing my own speaker's outline for this, but I don't know why you guys are all here. Don't you know that the world is going to end on November 23rd? Right? So we're getting just an awful lot of business because everybody's afraid of what the super committee might do. So I just didn't have time to prepare my own notes for this. So I'm just reading off of my own outline. So this is a very interesting development that happened this year regarding potential application of gift tax to 501c4 organizations. So this made a couple of the major newspapers. And so even though it's not a rev rule or anything like that, I thought this would sort of fall under non-tax developments. So the IRS has long held the position for decades that contributions to 501c4 social welfare organizations, which can be made without disclosure, are subject to the gift tax. And their reasoning behind that is that all contributions are subject to gift tax unless there's a specific exception made for that. And so the specific exceptions that have been made are to 501c3 organizations and to 527 political organizations, and those are the only ones. So a 501c4 organization isn't either of those two things, so it must be subject to gift tax. And they issued, I think, a ruling on that in like 1982, and they haven't really said anything about it since. And so they've just held that position and haven't really, that was the last word that they said on it. Now, notwithstanding that the IRS has held that position, enforcement in this area has been basically non-existent. And you can see why that might be a problem to enforce. If these things are not subject to disclosure, how are you going to enforce it? So anyway, it's my understanding that a lot of people who contribute to 501c4 organizations, in fact, don't pay the gift tax. And so that all came sort of into question earlier this year because five donors to 501c4 organizations got a letter from the IRS. I actually have it in my notes here. You can see that this is not in your materials, but I pulled this off of the internet, so it must be true. You can see the parts that have been redacted out of it. So one of the attorneys representing some of these donors forwarded this. I think they sent it to like the New York Times or Politico or something like that. And the IRS basically told these 5 donors, we understand that in the 2008 election cycle, you made contributions to these 501c4 organizations, and it looks like you didn't pay the gift tax on that. And as you well know, these things are subject to gift tax, and we're going to examine this transaction. So just as a little background to 501c4 organizations, as I said before, they're not subject to disclosure. They're supposed to be social welfare organizations, not primarily political organizations. Now, they can participate in campaigns. They can do an unlimited amount of lobbying as long as it's in accordance with their social welfare purpose, but they're not designed primarily to be sort of political actors, and yet because you can donate to them anonymously, their use and potential abuse has really grown over the past few years. And so the IRS, I think last year, they announced that, well, we've mainly been focusing on 501c3 organizations, but now we're going to take a closer look at these 501c4 organizations. And so I think this examination of these 5 donors kind of arose out of that. And now, after there was a lot of fluster and comments about this, another internal memo came out from the IRS, and this is also not in your notes, but if you want it, you can ask me or pull it off the web as I did. So the Deputy Commissioner for Services and Enforcement sent out a memo basically saying, well, given the fact that we don't have a lot of enforcement history about this, and since this is sort of a thorny issue, we're going to look at this internally a little bit more before we decide what we're going to do. And in the meantime, they called off all of the current examinations and said that any future examinations would only be after prospectively, after notice to the public. So what's the takeaway from this? Well, I think at this point, this is no longer a trap for the unwary. We're now on notice that the IRS is going to be looking at the gift tax implications of donating to 501c4 organizations. And certainly, whereas before you could have made you could have said, well, there's a fairness question here, because even though they said long ago that these were subject to gift tax, they haven't done anything about it. Well, now, you know, I don't think going forward you can make that kind of argument. It's just kind of interesting, the timing of this, since, you know, these were people who made donations in the year 2008, and I think the IRS started to really look at this after I think the 2010 midterm elections. And so now going forward, you know, these don't look like such a great vehicle for just funneling lots of money into political campaigns. So I thought that was a very interesting sort of development, one that you don't often see every year. Moving on to page 20. This is a series of PLRs. PLRs 2011-29, 016, 018, 019, and 020. These were all related. This involves qualified real property. And so this is my first exposure to this, so anybody who knows more about this than I do, there's probably a lot of you. But qualified real property is property usually either farmland or real property that's being used for a trade or a business. And it gets special valuation treatment when you're passing it down to the heirs. So say you have a family farm, and the family farm represents a significant portion of the estate of that decedent. So I think, I don't know all the technical rules for this, but I believe it's that the value of the farm has to exceed like 25% of the total value of the estate, and then the family farm plus personal property that are devoted to that qualified use exceed like 50% of the estate. So where you have a lot of the assets of the decedent's estate tied up in this land, then the IRS is kind of willing to give you a break in terms of valuing that for passing it along. So instead of valuing it at its highest, best fair market value, they're going to value it at the value for which it's being used, the qualified purpose, so use in farming or use in a trade or a business. Now, in order to get that special treatment, it really imposes an obligation on the heirs to continue using it for that treatment. And also, in order to qualify for that treatment, before the decedent's death, I think 5 of the last 8 years before the decedent's death, it has to be used for that qualified purpose. It has to be held by that decedent. If they're not using it because they're retired or things like that, I think you can get some special exceptions. But basically, you have to have used it before the death, and then afterwards it has to be held either by the qualified heirs or this exception that we're going to get to in this private letter ruling. So there's 2 triggers that will result in a recapture tax. If the qualified heirs dispose of the property, there's within 10 years, then there's a recapture tax. Or if there's a cessation of use for the qualified use, then you also trigger that recapture tax. So basically, the heirs have to sort of bind themselves to the IRS and promise, you know, across their heart that they're going to continue to use the farm for the farmland purposes, or, you know, if it's for a trade or business, continue to use it for those purposes for up to 10 years. They have, I think they have a couple of years to start using it for that purpose, but the 10-year clock doesn't begin to run until they've started to do that. So in this situation, in these private letter rulings, the decedent had a farm. He, through the will and a series of disclaimers, partial interest in the farm passed to his children and to certain trusts for his grandchildren. This farm was, at the time of the decedent's death, subject to a 10-year lease. I think there was like 1 year left on the lease. So this is what they decided to do. All of the beneficiaries wanted to transfer their interest in the farm to 4 LLCs in return for interest in those LLCs. And then each of the LLC agreements prohibited transfer of any interest for 10 years. All of the LLCs promised that they would be sort of liable to pay the recapture tax if it came to that, and all of the beneficiaries separately agreed that they would also be responsible for the recapture tax. And then they also wanted to, after these LLCs were formed, each of the LLCs were going to lease the land to the partnership that had been leasing it before. So what are the two triggers that we want to make sure that we avoid? Well, you can't dispose of the property to somebody other than a qualified heir, and you also can't cease to use it for the qualified purpose. So the IRS looked at the legislative history, which said, the legislative history for Reg 20-2032A-3B1, which says that for purposes of determining whether it was used for the qualified use before the decedent's death, it can either be held by the decedent or it can be held by a closely held business. And so, you know, the decedent could be holding it in an LLC before his death, and that would still count. And the IRS said, well, we think that the legislative intent would also apply that to the heirs. So, so in this case, that's exactly what happened. The heirs were holding it through the LLCs, and that was deemed not to be a disposition of the property that would trigger that recapture tax. And then as far as the lease goes, there's a case on this point, Estate of Gavin v. United States, which is a 1986 Seventh Circuit case. In that case, the lease said that the person leasing the property could either pay cash or they had the option of paying a crop rent. And in that case, they found that that was a requirement of substantial dependence upon production, meaning that they would, that means that they would have to keep producing, using it for the qualified purpose, was met. So in these PLRs, because their lease was substantially similar to the lease in Gavin, they found that there was no cessation of use, and so no recapture tax would be imposed on this. So this is a farm case, but I think it's also interesting from an estate planning perspective because it wouldn't just be for farmland necessarily. It would be for any real property that could qualify for this qualified use. So property that's tied up in the family business in some way, if that's a significant part of the estate, that you can either give it directly to the heirs or you could have these LLC transactions as described in these PLRs. So I've got about 5 minutes left. Talk about the proposed regs in light of the Knight v. Commissioner case. This is on page 26. So this is another Supreme Court case that people have been talking about for a few years. Basically, the background of this is regarding miscellaneous itemized deductions, specifically for estates and non-grantor trusts. So normally, miscellaneous itemized deductions are only allowed to the extent that they exceed that 2% floor of adjusted gross income. So you can't make those deductions until they're greater than 2% of the income of the estate or the non-grantor trust. But there is certain exceptions for estates and non-grantor trusts, including where the costs incurred with the administration of the estate or trust would not have been incurred if this were held by a private investor. So we know that investment costs for trusts are different than just a regular investor. So if it's different, an exception is made. But the regs have changed in the past few years about that. In July 2007, the IRS issued proposed regs that said that those costs would have to be unique to estates or non-grantor trusts in order to not be subject to that 2% floor, which is a fairly strict standard, you would think. The costs would have to be unique, and that's the word that they used. And then the Supreme Court in the state of Knight v. Commissioner ruled on this issue, and there was a split in the circuits, and they upheld that idea that that these are still subject generally to the 2% floor, but the Supreme Court was a little bit more lenient as far as what you would have to do to be accepted from that, and they said that the costs for investments, for example, if they were not commonly or customarily incurred by individuals, then you would not be subject to that 2% floor. So in light of the Knight decision, and also in response to comments from the public, in April of this year, the IRS issued some interim guidance in Notice 2011-37 that said that for the time being, until final regs are issued, first of all, you don't have to unbundle fees. And so one way that the IRS was wary about people trying to circumvent this 2% floor is if your fiduciary fees were bundled together with your investment advisor fees, and then you wouldn't have to pay them because you say, well, this is an exception to that 2% floor because these are fiduciary fees, that normal investors wouldn't have to incur. And the IRS said, no, you can't do that. You have to unbundle those fees and somehow allocate what fees are specific to the administration of the trust and which are investment advisor fees, because as we all know, individuals hire investment advisors too. So for the time being, until final regs are issued, you don't have to unbundle those fees. So that's good, at least for the interim. And then also, in light of the Knight case, the IRS issued new proposed regs. They withdrew the old proposed 2007 regs and issued new regs that are just going along with the Knight case. So no longer do these fees incurred by estates and non-grantor trusts have to be unique, but if there's an unusual investment objective of the estate or the non-grantor trust, or a specialized balancing of interests, so a trustee, when they're making investment decisions, has to think not only about the current beneficiaries, but also preserving the principal for remainder beneficiaries, and so that may be more costly than a normal person just investing for themselves. And so in that case, a reasonable comparison with individual investors wouldn't really be fair, or it's not reasonable to compare it to individual investors, and so they're willing to make an exception to the 2% floor in that case. And you still have to unbundle your fees under these new proposed regs, but you're allowed to do any kind of reasonable method to do that. So there was some concern after the previous 2007 regs that this would be very costly, that trustees and estate administrators would have to get expensive software to somehow unpackage their fiduciary fees from their investment advisor fees. And the new proposed regs that say, with some exceptions, you can use any reasonable method to sort of unscramble that. So the takeaway from this is, for the time being, I guess bundle your fees together because you're not subject to that 2% floor, and then it looks like, in light of the Supreme Court case, these are probably going to be something like what the final regs will look like. So as I said before, I don't have any big takeaway from all this. It's just been a very interesting year in estate planning generally. Thanks.
Thanks. Our next speaker is Will Lunger of Martin & Lunger. Will is a graduate of Widener University School of Law and has an LLM from Georgetown. Will is going to be opening up his crystal ball to talk about the potential future of the estate and gift tax and generation skipping tax.
Thanks, Richard. The good news is that I actually have something to talk about this year about tax laws. The bad news is that I'll probably be here next year talking about the same thing, trying to figure out what these tax laws are going to look like moving forward. What I'd like to do, as Richard said, is to review the current transfer tax regime and then provide some thoughts on what might happen regarding future legislation. I'm also going to mention some planning issues to consider in connection with the current legislation and the possible new planning. I'm not going to go into the increased exemption amount and planning for that because that's going to be covered this afternoon. All right, so where are we now? You all know that on December 17th, 2010, President Obama signed into law the 2010 Act. In addition to the variety of income tax relief provisions that the Act had, it also contained several changes to the federal transfer tax laws. Unfortunately, these laws are scheduled to expire on December 31st, 2012, and as such, the relief and opportunities presented in the 2010 Act are temporary, and absent new legislation, uncertainty will continue to exist in estate planning. If Congress does not act before 2013, there will be a return to the 2001 transfer tax laws with exemptions limited to $1 million and rates as high as 55%. You all know the basic provisions of the 2010 Act, but I'll just summarize them really quickly. We have a $5 million estate, gift, and GST exemption amount. The exemption amounts are indexed for inflation, and pursuant to a recent RevProc, the exemption amount for 2012 is going up to $5,120,000. So keep that in mind if the laws don't change in the meantime, that for those people who do want to maximize their gifts, there'll be a little extra to be able to give in 2012. The maximum tax rate's 35%. The estate tax exemption amount is portable, which I'll come back to in a bit. The GST exemption amount is not portable. And then finally, the step-up basis rules are preserved, which is good so that we don't have to worry about carryover basis. One of the key components to the 2010 Act was the introduction of portability. And essentially that just means that the unused portion of the deceased spouse's exclusion amount can be added to the exclusion amount of the surviving spouse, which can then be used for lifetime transfers or transfers at death. To say it a little more technically, the applicable exclusion amount for a surviving spouse is the sum of the basic exclusion amount, which is your $5 million indexed for inflation after 2011, plus the deceased spousal unused exclusion amount. There's some funny, I can't even pronounce it, Desui, or there's some way to say it a little easier, but I'm going to just call it the unused exclusion amount. But what that is it's equal to the lesser of the basic exclusion amount, which means that if the exclusion amount goes down at the time of the death of the surviving spouse, that number will go down. And I'll do a quick example in a minute of that. Or it is the basic exclusion amount of the last deceased spouse of the surviving spouse, less the taxable estate and adjusted taxable gifts. Two quick examples. Husband dies when the exemption amounts $5 million and he has $1 million taxable estate. The deceased spouse exclusion amount would be $4 million. So it would be the $5 million less the $1 million taxable amount. So the surviving spouse would have a total of $9 million. Same facts, but the wife dies when the exemption amount is down to $3.5 million. In that case, the deceased spousal exclusion amount would instead be $3.5 million instead of $4 million, because again, it's the lesser of those two numbers. It can get a little more complicated than that when you have a spouse die and then the spouse gets remarried. This raises the so-called privity issue, which means can a spouse use his or her spouse's deceased spousal exclusion amount? I think the answer to that is no, but there was a technical correction that was issued by the Joint Committee on Taxation that seemed to imply that you can. I'm not going to run through examples on that again. It just gets a little complicated. I think the point is I think we might need a little more guidance on some of this to figure out exactly how to calculate the spousal exclusion amount in all situations. In Notice 2011-82, the IRS reminded us that executors need to file a timely Form 706 in order to take advantage of the deceased spousal exclusion amount. Form 706 is required to be filed even if a return would not otherwise be required to be filed. The election is deemed to be made if you file the return in a timely and complete manner, computing what exactly this unused exemption amount is. So you don't need any affirmative statement or other indication. It's a deemed allocation or deemed election. There is a mechanism to elect out of that, and I haven't quite figured out why you would do that, but there is a procedure to elect out of that if you wanted to. One question that comes up in my mind is, will the IRS simplify the method to make the portability election? It would be nice if they do that, but I wouldn't count on that because the IRS does need they need the information to calculate and verify what that unused exemption amount is going to be. I also point out that the IRS may review that Form 706 without regard to the passing of a statute of limitations. So there is no statute of limitations for purposes of the IRS redetermining what that amount was. People advising executors of estates will need to be very careful to document in writing the decision whether or not to file a 706 on the death of a first spouse if one's not going to require it. It's going to be a real landmine when it turns out that a 706 should have been filed and you don't have something in your file indicating that you advised as such. I'll come back to portability in a minute and just discuss some planning issues. But what I wanted to do is just take a quick look at the at possible new legislation and what it might look like. My materials have the whole history of the 2009 and 2010 bills leading up to the 2010 Act. I'm not going to go through all that, but I still think that it is a good idea just to look at those because they do set forth some common themes on what they're thinking about. I will mention one recent proposal, though, and that was on February 14th, 2011, the Treasury Department issued the administration's fiscal year 2012 revenue proposal, which is the so-called Green Book. And this Green Book had similar proposals to what President Obama had previously proposed, and that was consistency of basis, limitations on valuation discounts, and minimum terms for grats. But it also included two additional proposals, and those were extending portability, making that permanent, and limiting the duration of GST exempt trusts to 90 years after the creation of the trust. I'll come back to those proposals in a minute. So what are my predictions on where this is going to end up? It's hard for me to say. From a timing perspective, there have been rumors flying around about this so-called super committee and what they're going to do. And the rumor has been they're going to come out November 23rd with a $1 million exemption amount for gifts, so reducing it to $1 million, and it's going to be effective November 23rd. I do not believe that that is the case. I think that's very unlikely as to the timing and the number. But it is something that's a little scary to be on the wrong side of that advice. So I sort of view it as a good opportunity to just be able to get to those clients that have been not responding as quickly as they should to some of this and let them know that, just remind them that these laws can change very quickly. One difficult question that comes up is what to do if you're trying to accelerate gifts connected to discount planning. Let's say the client's been considering doing an LLC, either creating it or funding it, and they haven't done anything yet. And so the question is, what do you do now if you are concerned about changes in the tax laws, either the exemption amounts or limitations on discounts? On the one hand, you don't want to sit around and not have made the gift. On the other hand, it really doesn't look good if you're doing this transaction that quickly, funding it and then making an immediate gift. You really need to let some time go between the transactions to bolster those non-tax purposes. I don't know what the correct answer is to that. Ideally you present that to the client, the pros and cons of each, and let them make the ultimate decision, but they're of course looking to you for guidance on that. So if the super committee doesn't deal with transfer taxes, which I think is likely, when will this happen? Will it be enacted prior to the election? Will it be a part of the budget deal? Will it be in the lame duck session, or are they going to wait until the exemption amount goes back to $1 million and then try to deal with it then? I'm just not sure on this. Given the state of affairs, it would surprise me if they're able to get their act together. But who knows? And the election, if they don't do it before the election, I think the election results will clearly impact the direction of this. All right, what will the exemption amount be? I don't think it's going down to $1 million. I even think, to me, it's a little unlikely it will go back to 3.5. I think people like 5 million, and it's hard sometimes to take things away. Just look at the Bush tax cuts. It's hard to undo things once you've given that to people, but who knows? It's possible that the gift and estate tax will become ununified, but my guess would be that it does remain unified. It's possible that indexing the exemption amounts for inflation will continue as it exists now. I think that's very possible. As for the rate, for the reasons I said about the exemption amount, I think 35% is maybe where it's going to end up. 45% would probably be on the high end, but I don't think we'll go much higher than that. It is possible that you're going to see some surcharges for very large estates. I know that's been proposed on occasion. I don't think it's I don't think it's likely, but it may happen. If so, I would imagine that the definition of what a large estate is would also be indexed for inflation. Is repeal still a possibility? Yes, I think it is. Repeal does have fairly broad support. Recall that back in 2000, Congress passed the Death Tax Elimination Act of 2000 that was vetoed by President Clinton. So it was pretty close. Remember also that a lot of members who were elected to Congress in 2010 signed pledges to work towards repeal. Having said that, I still think it is a long shot. All right, what other provisions might be in the bill? And the question is really, are they going to try to do comprehensive legislation, or are they going to try to just stick to the rates and exemption amounts? If they do focus on other things, limitations on discount planning is one that keeps coming up. Back in the 90s, there were proposals to limit discounts. Budget proposals from President Obama in the Green Book, 2010, 2011, and 2012 included that. The Joint Committee of Taxation issued a report in 2005 that was in favor of getting rid of discounts. And some of the various bills that came out in 2009 and 2010 had that as well. I don't know how likely that is. If I had to guess, I would say it's something that won't be addressed in new legislation. Limitations on dynasty trusts. I mentioned the 2012 Green Book included that. The 2005 Joint Committee report included that. Obviously, from a Delaware perspective, that would not be good. We don't want that to happen. But I would say that that's an unlikely one. I hope so. Comprehensive legislation would also likely include discounts or special valuation rules for our friends, the farmers and the small business owners. And then finally, GRATs. There's been this thought that no risk GRATs are a problem, and so the idea has been to increase the mortality risk by either having a minimum 10-year term or some percentage for a gift up front. I think the idea to limit GRATs hasn't really met up with too much hostility or criticism, and it can be used as a revenue offset. So it seems to me that if there is comprehensive legislation, that may very well be something that does get into the legislation. From a planning perspective, what does that mean? Should everyone rush out and do their 2-year GRATs? Maybe, but I would think that you also want to look to the intermediate GRATs as well. Keep in mind that we have an extremely low interest rate. The 75/20 rate's very low, and it's an opportunity to put assets into a GRAT for a longer period of time. So if rolling 2-year GRATs is not an option, then your intermediate GRAT might be a very good idea. All right. To come back to portability and just to mention a couple issues there. The question is really, how is this going to impact planning and drafting of documents, and how is it going to influence clients and their willingness to undertake comprehensive estate planning and asset coordination? Frankly, portability has been something that I haven't focused on entirely. It's sort of like the modified carryover basis rules that were introduced in 2001. I didn't want to worry about learning something that was hopefully never going to come into being. I sort of thought the same thing about portability. If it's a 2-year thing, do we really need to be that concerned about it? But I do think it is something that is likely to make itself into legislation, and so I do think we're going to need to give some more thought to that. Portability sounds good at first, but the qualifications, it might be expensive to do so, and the benefits remain uncertain, I think. And so I believe that credit shelter trust and marital trust planning continue to be preferable in a variety of circumstances. Reasons include the fact that portability is limited in situations with multiple marriages. You have that last deceased spouse limitation. There's no portability as to the GST exemption amount. So if you're doing GST planning, you'll need to do your credit shelter arrangements. Portability does not shelter income and growth. So in those borderline situations, you'll probably need to rely upon credit shelter trusts. The filing of a Form 706 can be avoided if the estate's not otherwise required to file a return. A credit shelter trust would be needed if there are children from prior marriages or if there are concerns about remarriage. And then finally, portability does not provide the various benefits that are associated with having assets in further trust, such as professional management and protection from creditors. Portability does have some advantages, though: simplicity in drafting, ease of asset coordination, comfort for the surviving spouse. Money in hand is sometimes preferable for a surviving spouse. And there may be some income tax disadvantages to your credit shelter trust because that will not be included in the surviving spouse's estate. One question that comes up is, from a planning perspective, is there a way to draft that credit shelter trust to cause includability in those situations where it makes more sense to have includability, so you don't have adverse estate tax consequences, but you get the benefit of the basis step up? And I've seen some thoughts on that. I don't know if there's a real definitive way to do it, but I have seen some thoughts as to granting someone, an independent person, the power to give the spouse a general power of appointment if it's appropriate. One question that people ask, that I've seen clients asking, are disclaimer trusts going to be the way that people deal with portability? Everyone seems to like disclaimer trusts in theory because of the flexibility that it provides, the power to make that decision at a later point in time. But keep in mind, there are some disadvantages to disclaimer trusts, including that disclaimers can be complicated and expensive. Surviving spouses often do not make the right decision as to what to do, and the surviving spouse cannot retain a limited power of appointment over that trust to direct how it goes. So you don't get that flexibility that a credit shelter trust affords. And finally, disclaimers may be limited under state law in certain circumstances if the surviving spouse is insolvent. Just a couple other quick thoughts on portability and some planning issues. Should credit shelter trusts be drafted to be able to qualify for the marital deduction? We used to do this here in Delaware back when we had the Delaware state tax, so that we could qualify the credit shelter trust for the marital deduction. But we kind of got away from that because of the idea of adding more flexibility to our credit shelter trusts, so that income would be discretionary, for example, and income and principal could be used for lineal descendants, as opposed to forcing the all-income requirement. And limiting on who could be discretionary beneficiaries. Again, the idea is, can you give someone more flexibility at a later point in time to decide what's better, portability or using the exemption amount on the death of the first spouse? Similar issues could come into play in the drafting of your formula clauses, trying to figure out, give the executor more discretion on how to make those allocations and what to claim the marital deduction for. Finally, just to mention gifting, I think gifting to take advantage of the deceased spouse unused exclusion amount would take on a whole new thoughts and ideas. How do you take advantage of that without losing it later? So in conclusion, assuming that portability does become permanent, I think it's something that we're going to need to plan for and give more thought. While I think that traditional credit shelter marital trust planning is going to remain preferable in many situations, I do think that portability is going to impact our overall approach to estate planning. Thank you. Okay, and finally, we have Richard Popper, a partner of Young, Conaway, Stargett, and Taylor, who will be presenting on estate planning for Delaware same-sex couples following the enactment of the Civil Union and Equality Act of 2011.
Thank you, Will. So, in the past 2 years, I've been up here talking about the Delaware estate tax. My topic has traditionally been state law considerations in estate planning. There really aren't any developments worth talking about in the Delaware estate tax. There's still a technical correction bill that's hopefully going to be introduced and passed in January, but nothing worth refreshing that presentation. So fortunately, we have something new and very interesting, which is the Delaware Civil Union Statute. Now, this was enacted in May of this year, and it's effective January 1, 2012, pardon me, at 10 a.m. That, I guess, will allow people performing marriages to sleep in until, until 10 o'clock on New Year's Day. As a background to this, as everyone I'm sure knows, we have DOMA, which is the Defense of Marriage Act, which is federal legislation which was enacted during the Clinton administration. That statute generally provides that courts of a state are not required to recognize a marriage performed in another state or another jurisdiction unless it is between two parties of the opposite sex. And DOMA also generally prohibits recognizing marriage for parties between the same sex for federal law purposes. So that what Delaware has done with its civil union statute, which I'll outline briefly in a moment, is ostensibly going to apply for Delaware law purposes only, at least for the time being. But I am going to talk about some cases that maybe suggest that that's not all there is. But basically what the statute allows is it allows parties of the same sex to enter into a civil union beginning on January 1st, and generally provides that current parties to a civil union, former parties to a civil union, and deceased parties to a civil union are all going to be treated as though they were legally married under Delaware law for all purposes of Delaware law. And then something very important to the overall treatment of civil unions is Section 212D. And that's on page 2 of my outline. And basically what it says is if a state law, that means a Delaware state law, refers to or relies on federal law in a manner that would treat parties to a civil union differently than married spouses, then parties to a civil union shall be treated in all respects by the laws of this state as if United States federal law recognizes a civil union in the same manner as laws of this state. That's critical for the Delaware estate tax, critical for Delaware income tax. And even though this presentation is supposed to be primarily about estate planning, I'm going to mention some income tax issues that are going to come up with parties in a civil union that the accountants in the audience are going to have to be dealing with when preparing returns. Basically, Delaware also recognizes a civil union or a marriage between two parties of the same sex that was validly performed under the laws of another state as though they were Delaware civil unions, assuming that they met the requirements of Section 202 of our Act, and they provide substantially the same rights, benefits, and obligations as a Delaware civil union. So presumably marriages in Massachusetts, New York, Iowa, those that were valid in California, and civil unions in New Jersey are going to be treated as civil unions in Delaware if the parties move to Delaware. This Delaware statute is limited to parties of the same sex. Parties of the opposite sex cannot enter into a civil union under Delaware law. I guess they either have to continue to live together and not marry, or they have to get married. No civil union option for those parties. Now let's talk about planning considerations. Before entering into a civil union, you may want to consider a prenuptial agreement. Now remember, Delaware law, as I said, treats parties to a civil union as though they're married for all state law purposes. That means that all of the provisions in the Delaware Code relating to prenuptial agreements between parties about to get married are also going to apply to parties intending to enter into a civil union. And your prenuptial agreement can cover all sorts of topics. It can cover how the parties will control pre- or post-union property, the disposition of property on separation or dissolution of the union, alimony. Yes, you can now have alimony between civil union parties because they're treated like they're married, modification or elimination of that alimony, rights of parties under wills, trusts, life insurance policies, pretty much anything else under the sun that you want to cover. So that is an important consideration. Parties who have moved into the state of Delaware and, for example, who had been married under the law of Massachusetts now live in Delaware, their relationship is going to be upgraded effective January 1st in Delaware from something that is not recognized to something that is recognized as a civil union. Those parties in that position might want to consider entering into a postnuptial, prenuptial agreement between now and the end of the year. And then certainly parties who are planning to enter into civil unions should consider entering into these contracts. One of the other interesting things in the Act is if you enter into a civil union, now of course it's treated as a marriage. Some civil unions will not last forever, unfortunately. They will end in divorce. And you can have a divorce of a civil union under Delaware law. If you still reside in Delaware, no problem. The family court will have jurisdiction to dissolve your civil union just like a traditional divorce. But the Delaware statute also provides if you leave the state, you go live in Kansas, which doesn't, as far as I know, recognize civil unions, and then you decide to get divorced. Kansas, and I don't want to pick on Kansas, just the first state that popped into my mind, but if the Kansas courts say we're not going to take jurisdiction over this because we don't recognize this as a marriage to begin with, you can come back to the family court in Delaware for dissolution of your civil union. So that basically covers the prenups and the family law aspects. There are quite a number of provisions of the Delaware Code which govern what happens when somebody dies. And again, because a party to a civil union is going to be treated as a spouse for Delaware state law purposes, we want to go through these statutory provisions. These are going to apply to people who don't do good planning, don't do enough planning, or don't do any planning. So first of all, the surviving spouse's allowance will be applicable when the first civil union party dies. Surviving party can receive the $7,500 surviving spouse's allowance. Surviving spouse is going to be treated, surviving party will be treated like a surviving spouse for purposes of determining the intestate share of an estate. There are various fact patterns that you go through in the intestacy statute to determine the share of the surviving spouse. Generally, it's the first $50,000 of the intestate personal estate plus half the balance of the intestate personal estate. There are some instances, depending on whether there are children or parents, where this first $50,000 amount does not apply. There are issues, special issues involving children. If there are surviving issue, all of whom are issue of both parties, then the intestate shares the first $50,000 plus half the balance. But if there are surviving issue, one or more of whom are not issue of the surviving spouse or surviving party, then half the personal intestate estate So we don't have that $50,000 preference. If a same-sex couple adopts children, probably no issue, but there may be many situations in which a child is born in a same-sex relationship after the civil union has happened. Delaware law presumes that that child is going to be a child of both parties to the civil union, but it's a rebuttable presumption. So if one of these parties dies, the $50,000 preference may be an issue depending on whether or not it's a child of both parties. All I can say is plan, get wills. Don't have the intestacy statute apply. The last thing we want to deal with is something like this. The surviving party is going to have rights under the Delaware elective share statute. I'm not going to go through the entire statutory scheme, but will be treated just like a surviving spouse for purposes of Delaware elective share statute. So if you have estate planning documents which do not provide at least 1/3 of the estate to the surviving party, this may come into play. Real estate issues. Tenancy by the entireties is available to civil union parties effective January 1st. When you're preparing a deed for such parties, I think you would want to make clear that it is a tenancy by the entireties in the deed. Tax issues. This is what we're all here for. Delaware estate tax. Delaware estate tax is going to have to recognize a marital deduction for civil union parties. When the first party dies, anything passing outright to the surviving party, anything passing to the surviving party in the equivalent of a Q-tip trust is going to have to qualify for the Delaware estate tax marital deduction. It's possible, since the Delaware estate tax is only scheduled to last till the middle of 2013, that we will never actually have an estate required to file a federal estate tax return in which there is a surviving civil union party. So this may actually never come up, but it may. Interesting issues for federal estate tax purposes. When you have jointly owned property between two parties, if it's husband and wife, assuming there's no non-U.S. citizen, there's an absolute presumption that the property, 50% of the property was contributed by each spouse, so 50% will be included on the federal estate tax return. And your basis step-up will apply to 50%. However, if you have a same-sex couple owning jointly owned property, whether it's tenancy by the entireties or just merely joint with right of survivorship, federal law goes back to the rule of contribution, which means the first party to die is presumed to have contributed the entire contribution to the property. You can rebut that presumption. That means more of it includable in the estate for federal estate tax purposes. Now, for Delaware estate tax purposes, it's not going to make a bit of difference. You actually get a full deduction because it's passing to a surviving spouse for Delaware estate tax purposes, but you are going to have a difference in the basis of the property for federal purposes and Delaware purposes. For federal purposes, rule of contribution applies. For Delaware purposes, how much was includable in the first party's estate, that's what's going to determine the basis, what portion gets a step up or step down in basis with the real estate market these days at the first party's death. So you're going to have potential for non-uniform basis. For Delaware income tax purposes, I have outlined a whole slew of issues which can come up in filing income tax returns where your Delaware state income tax is now going to diverge from your federal income tax return. I was talking to Hank Rhodes out in the hall before this presentation, and I suggested to Hank, because these issues are numerous and the print on the Delaware income tax return is already small enough with the various places you have deviations from federal income tax purposes, that we put a line on the return that basically says adjustments from schedule whatever. And then parties in civil unions filing joint Delaware income tax returns can file a separate schedule which has all of these adjustments on it. So we can still read the Delaware income tax return without a magnifying glass. Basically, just to sum some of these things up, you're going to have some situations in which you're going to be able to claim an exemption for your partner or the other party in the civil union that you would not be able to for federal income tax purposes. You may have a different number of exemptions on your returns. You may be filing jointly for federal purposes, for Delaware purposes, but not for federal purposes. If one party is covering the other party under an employer-provided health plan, federal law requires that the party who is the employee include the cost of the coverage of his partner in federal taxable income, because that person is not a spouse. Delaware will have to allow you to exclude that from taxable income. Non-uniform basis of assets, which can result from various things, including, for example, a Q-tip type trust created by the first party to die, which will qualify for the marital deduction for Delaware, but not federal estate tax purposes. When that surviving party dies, probably includable in the estate for Delaware, but not federal purposes. Non-uniform basis between federal and state income tax. Jointly owned property, which I already discovered. Here's one that's interesting. Grantor trusts. You could have something that's a grantor trust for Delaware state income tax purposes, but not federal income tax purposes, because Section 672 of the Internal Revenue Code ascribes the rights of spouses to the grantor to determine whether something is a grantor spouse. Federal law will not recognize the same-sex party as a spouse, but Delaware will. So you're going to have some trusts potentially which are going to have to file as grantor trusts for federal, as separate trusts for federal income tax purposes and as grantor trusts for Delaware income tax purposes. There are also issues concerning passive losses. Let's talk briefly, I guess I have about 5 minutes left to talk about estate planning. One thing, this will apply not just to your same-sex clients, but to your clients in general. It's very common for wealthy clients to provide for, in the context of doing generation skipping trust planning or just other planning, we provide a trust for the benefit of a child, income to the child for life, or income or discretionary distribution of income, followed by a power of appointment, which provides that the child may exercise the power of appointment in favor of his or her issue, and may include a power of appointment in favor of a spouse. Okay, Delaware law says treat same-sex civil union partners as spouses. So if one of your client's children enters into a civil union, is the civil union party a spouse who is entitled to receive an income interest for purposes of this trust? I think the answer probably is if you sign the trust on or after January 1st of 2012, yes. But it's probably best to put in a definition. You need to go over this with your clients. How do you want to define spouse? If you define spouse in a more restrictive way in your documents to say it's only a spouse of the opposite sex, there is a possibility that that definition might be considered void against public policy if this ever comes up. On the other hand, Section 3303 of Title 12 gives Delaware residents a lot of freedom of disposition in creating estate planning instruments. So we don't know where that's going, but it's definitely something you need to consider in any estate plan which uses the word spouse. Okay, estate planning for civil union parties. If you have a size of an estate where there is never likely to be an estate tax liability for federal purposes, you may wish to provide a general power, something that's like a general power of appointment marital trust for the benefit of the surviving party, so you can get a second basis step up at the surviving party's death. You may also, and this is, I think, fairly common in the estate plans I've done for civil union parties where there's substantial wealth, you don't want to do an outright disposition from the first party to the second party because you get no marital deduction for that, and when the surviving party dies, it'll be included in the surviving party's estate for federal estate tax purposes, so you may pay federal estate tax on the same assets twice. What you would normally do is provide something that looks like a Q-tip trust for the benefit of the surviving party. Surviving party gets income, surviving party may or may not be the trustee, gets principal pursuant to an ascertainable standard, then it goes wherever on the surviving party's death. Now, for federal estate tax purposes, there's no marital deduction available for such a trust, but it also won't be includable in the surviving party's estate for estate tax purposes, so you won't pay tax on it twice. What you can do, there's an estate tax case pending in New York State in the federal court right now. It's at the very end of my outline, called Windsor, in which basically the surviving party is challenging DOMA and saying you have to give us a marital deduction. We had a valid marriage in Canada. And the U.S. is not really defending this case very aggressively. The House of Representatives is the one defending on behalf of the federal estate tax regime. What you may want to do when you actually have an estate with the first spouse to die and you have something that looks like a Q-tip trust is you file your federal estate tax return when one is required. You don't claim a marital deduction. Then it appears that you can file, if you file before the original due date, you can now in good faith file an amended return, say DOMA is invalid, it's unconstitutional as it applies to the federal estate tax. I'm entitled to a marital deduction, I'm making my Q-tip election. And there are many other things I could discuss, but I'm standing between you and lunch, so I guess I'd better conclude my presentation. Thank you.
Right, cut through, and as you go outside, you'll see it to your left. So hopefully some people can lead everybody there and you'll find it. There's a slight change, not a slight, there's a change in the agenda. Our distinguished speaker unfortunately had a medical emergency, and we did not receive notice till 11:15 that she is not coming. But the good news is that the person who is going to introduce her, Senator Carper, has agreed to stay and talk about issues on the Hill and open up for questions. So our distinguished speaker today will be Senator Tom Carper from Delaware, so we'll make sure and give him a warm welcome and many thanks.
Yeah, it's good that you have a backup plan.
Good afternoon. My name's Leo Strine, and I have the honor of introducing Senator Carper. Earlier this morning, when I was sitting in the audience where you were, Nick Murkey touched me on the shoulder and said, "Come here, I need to talk to you." And of course, he grabs me up, and that's when he tells me that our distinguished speaker had a medical emergency and wasn't going to be able to make it. Senator Carper was instrumental in finding and helping us get our speaker today. So I quickly got on the phone to let him know that he would not have to be here to introduce her. but we would love to have him speak. He told me he had laryngitis. And then he says, I'm on the phone to Senator Coons, and I'm on the phone to John Carney. We're not quite sure if we can get them there. And he says, and I said, Senator, does that mean you're going to be here? And he says, of course I'll be there. All right, so don't worry. And I said, thank you. I said, I'm in my serious mode, so I wasn't getting the joke. As it turned out, we're going to be lucky. He is a man true to his word. He is not only going to speak to us and take some questions, but we expect before he's finished that Senator Chris Coons will be here as well and add to the discussion. Congressman Carney, unfortunately, is stuck in Washington later than we would hope, so he will not be able to get us. On a serious note, I had a speech ready to introduce the senator. I'm going to say just a couple things, one thing about him. All right, and that is several years ago, my son Leo, where it was at that time the Governor Carper's legal counsel. And fortunately, occasionally, there is some time when my sons actually get to spend time with their dad, and we get to discuss. And that day we were discussing Senator Carper, or Governor Carper. And I said, why do you respect Senator or Governor Carper so much? And he says, Dad, for this one particular reason, and I think this is the greatest compliment you can give an elected official. He said, Dad, in any discussion we've ever had, due to policy or anything else, we have never discussed the political ramifications. The decision was always made on what was the right thing to do. I don't think we can ask anything more of our elected officials than that. So since we have a little bit of time here, I'd like to introduce a former Buckeye and graduate of The Ohio State University, an MBA graduate of the University of Delaware, a naval flight officer and 3-tour veteran of the Vietnam War, a man who many years ago had the courage to clean up the leadership of the Delaware Democratic Party, our former treasurer, U.S. Congressman, Governor, and the current senior senator from the state of Delaware, the Honorable Thomas Carper. What was the hand phone? You want to use the hand phone?
Popular would be great. If you want to bring it down. Hello, hello, hello. Not bad for laryngitis, huh? Leo, thanks a million. Thanks for inviting me to invite Maya MacGuineas and allowing me to stand in her place. How many have ever heard or seen Maya MacGuineas before? She is smart, she is beautiful, and she is as committed on deficit reduction as anybody I know. And she runs a sort of nonprofit down in D.C. that focuses on deficit reduction and trying to get people to work across the aisle. When Leo told me, I said, gave me some ideas several months ago, the kind of speaker they are looking for. We talked about Erskine Bowles or Alan Simpson, one of those guys. And I said, they're hard to get, but somebody who'd be, and Erskine was just here this summer at the University of Delaware. But I said, Maya MacGuineas would be just as good. And she is in the hospital. I think probably from exhaustion. She probably works harder on deficit reduction issues than all the super committee members combined. And she's, it's unfortunate she can't be here, but she sends her regrets, and she also sends me in her stead. And so I'm happy to have this chance. I got on the phone when we found out Maya couldn't come, and literally tracked down Chris Coons, who was presiding over the Senate at that time, and John Carney, who was voting in the House. And I said, if you guys want to stop by and say we're having a fundraiser and the people are giving $5,000 apiece. And if you can make it, we'll split it. And no, I didn't tell them that. Chris is coming anyway. John's still going to be voting. They're voting about 3 or 4 o'clock today in the House, so he can't come. I wanted to just back up just a little bit with what Leo said and try to set the stage if I can. What I really want to do is give you a sense for what's happening in Washington with what I think is the issue of our time, and that is, can we govern? And can we demonstrate the ability to behave in fiscally responsible ways in this state, in this country of ours? I was Born in West Virginia, grew up in Virginia, a place called Danville and Roanoke, and won his Navy ROTC scholarship and got to go off and be a naval flight officer in the Vietnam War. And served some time overseas and came back. It was 5 years in a hot war and 18 years in a cold war, and retired as a Navy captain a few years ago. I loved my time in the Navy. If you look at the sort of way I grew up, I picked the right parents. Maybe you did too. I think that's one of the keys to success in life. And my parents really instilled good values in my sister and me. And among those values, there's a Baptist church in Danville, Virginia, right? A Baptist church right across the street from where we lived. And my mother dragged my sister and me there every Sunday morning, every Sunday night, every Wednesday night, and most Thursday nights. And a lot of people think they don't have church on Thursday nights. Well, they do in Danville, Virginia. And we were at that church. My mom wanted to make sure my sister and me understood the responsibility for doing what was right. That was it. And that's a lesson I learned very early in my life. Figure out the right thing to do, just do it. Leo was good enough, and his son was good enough to mention that. His son, he's got two of the smartest sons that I've ever met in my life, and I was privileged to work with both of them as governor, and still consider them both good friends. The other core value I took away from living in Danville, Virginia, right across the street from Woodlawn Baptist Church, golden rule: treat other people the way we want to be treated. And I don't care what religion you are, you don't have to be Baptist for that to be the golden rule. Catholic, Protestant, any religion, Muslim, and every faith you can think of, somewhere in their sacred scriptures and their teachings, golden rule appears in one form or the other. My third sort of core value, really kind of growing up as a kid. You probably remember things your mom and dad used to say to you when you were a kid growing up, like you did something right or wrong, and they'd either compliment you or not. And my dad would always say to my sister and me, we'd do some boneheaded stunt growing up, and he was always saying to us, he was a chief petty officer in the Navy. Hello. You look familiar. What's your name?
Laura.
Laura, where do you work?
I work for Senator Carper.
Laura tells me what to do. She tells me where to go and when to do it. She's my scheduler. And we needed some help down in Washington the last several weeks. And she's literally done double duty, kind of like me, back and forth on the train. Lives in Dover and comes up to Wilmington, catches the train back and forth. What was your husband's name?
Ryan.
The first husband was Ryan. Then after about a week of this, he said, all right, thanks.
Let's try that.
Test. I don't know if that, I don't know if you all can hear. It needs to be higher. Yeah, please. Just right here. Right there. If you could.
You have this.
Hello. Quite a team, huh? We'll do comedy next. I'll try this. Hello? Hello? Not bad, huh? Yeah. All right, good. I'll hide the wire so you won't know I have it. Anyway, third core value from my dad. My dad was, we do a lousy job, whatever we do. My father always say, if a job's worth doing, it's worth doing well. That's what he'd say. If a job's worth doing, it's worth doing well. Your parents probably said stuff like that to you. I hope it was really good advice you remembered it. I remember those things. And my third core value is, if it isn't perfect, make it better. And I take that, I chair a subcommittee in the Senate that deals with federal financial management. And we have, it's such an oversight investigative subcommittee, and we have a chance to literally look in every nook and cranny of the federal government and see how can we do this better, how can we get a better result. And the last core value I have is just don't give up. Just never give up. I remember meeting with Ariel Sharon in Israel a couple of years ago, and Jerry's heard me tell the story before, but he and Shimon Peres were putting together Kadima, which new political party means forward. This was about 2005, 2006. And at the end of the meeting, said Ariel Sharon had been on top as a general and on the bottom, and even up as a political leader had been demonized and lionized. And I said to him at the end of our meeting, Prime Minister Sharon, you've been up, you've been down, you've been a hero, you've been a heel. What's your secret to success? You always seem to be back on top. And he said, I'll never forget these words, he said, I never give up. So he said, I never give up. And I have a great quote from Winston Churchill, you probably heard it, never, never, never give up. That's my fourth core value. And I look through just about every issue that I face with those, through the lens of those, or prism of those four values. Figure out the right thing to do, just do it. Treat other people the way I want to be treated. If it isn't perfect, make it better. And finally, just don't give up. You know you're right, you think you're right, just don't give up. And I think the most important issue that they're working on right now in our nation's capital is trying to put ourselves on a fiscally responsible path, and doing so in a way that where we put ourselves in the shoes of other people, golden rule. And we also look in, throughout federal government to ask the question, how can we get a better result for less money? We, about 2-3 months ago, we had a hearing in the Finance Committee. Among our witnesses that day was a guy named Alan Blinder. Some of you remember Alan Blinder. Blinder is now a professor back at Princeton in economics. But that day he was just a witness before us. He used to be a vice chairman of the Federal Reserve when Alan Greenspan was chairman. We're having these witnesses, 5 of them, very smart people, were telling us what to do to reduce the deficit. And the one would testify after the other. We got to Alan Blinder, and he said, the 800-pound gorilla in the room on deficit reduction is healthcare. Unless you do something about healthcare, we're doomed. And he mentioned the Japanese, with whom we compete in a lot of ways. He said, in Japan, they spend 8% of GDP on healthcare. We spend 16. In Japan, they get better results. Everything from higher longer life expectancy to lower rates of infant mortality. In Japan, they cover everybody. And we put about 40 million people to bed here at night without health care coverage. He said, they can't be that smart, and we can't be that dumb. That's what he said. And he finished his testimony, and the other witness testified, and then it came back to us, you know, where we asked questions of the witnesses, and came to me to ask a question. I asked a question of Dr. Blinder. I said, Dr. Blinder, you mentioned healthcare costs, 800-pound gorilla in a room. Unless we do something about that, everything else is like window dressing. And he said, that's right. And I said, what advice would you have for us with that in mind? And he said, I'm not a health economist. I don't pretend to be an expert in this stuff. Let me just say, this would be my advice to you. Find out what works. Do more of that. That's all he said. Find out what works and do more of that. And I said, you mean find out what doesn't work and do less of that? He said, yes. That's right. And you know, there's great wisdom in that. I've thought about that almost every day since that testimony. And what I've tried to do is to make, I don't care whether we're looking at weapon systems, defense spending. I don't care if we're looking at healthcare. I don't care if we're looking at education. I don't care if we're looking at Pell Grants or the GI Bill. Everything, transportation policy, everything that we do. We need to ask this question. How can we get better results for less money? And I think there's 4 ways to do deficit reduction, and one of those is to cut spending. Another way is to raise taxes and raise revenues. A third way is to grow the hell out of the economy. And a fourth way is to actually get, wherever we can, better results for less money. In 1997, Erskine Bowles was the chief of staff for President Clinton, as you'll recall. He was asked by President Clinton to work with the Republican House and Senate to try to deal with the budget deficits. We hadn't balanced our budget since 1968, right in the middle of the Vietnam War. And President Clinton asked him to lead the negotiations with Republican House and Senate, and they did. They came up with a deficit reduction plan, 50% revenues, 50% spending. And we had 3 balanced budgets in a row, 99, 2000, 2001. Most people forget that. It wasn't that long ago. We were gone for 30 years without a balanced budget. And then back to back, we had 3 of them, one right after the other. I remember Alan Greenspan coming and testifying before the, the banking committee in about 2001, 2002. And he said, we have not red ink, black ink as far as the eye can see. We have surpluses for as far as the eye can see. He raised the specter, and he was worried that we would somehow pay down the debt too soon. And later in life, when I would run into him, I said, remember that day you testified that you're afraid we're going to pay down the debt too soon? I said, you didn't have to worry. Because we haven't. We haven't. And now we see red ink as far as the eye can see. One of the smartest things that President Obama's done, I think, was to take a legislative idea that we couldn't pass. We tried to create a deficit commission, couldn't pass it. And instead, 7 of our Republican co-sponsors voted against it. And we didn't have our 60 votes, so the idea died. But the president said, I'm going to use my executive powers and create a deficit commission. And who did he put in charge of it? Erskine Bowles and Alan Simpson. Erskine because he's done it before. Alan because he's a great guy, funny guy, but also just a great deficit hawk. He's out of the Senate now, so time to spend a lot of passion for the issue. And they worked for about 8 months with a lot of other good people, Democrats and Republicans in the House and the Senate, and folks outside. Maya MacGuineas is one of the people who provide a lot of input. Whenever I'd meet with that group, she would be around. She was never far away, giving good advice. But last November, you'll recall, they reported back to the President, the Deficit Commission reported back to the President, reported back to the Congress. 11 out of the 18 voted to endorse a package. And the package was basically this: $4 trillion over 10 years, weighted to the spending side, spending reduction. And you know, I said in the 97 deal that Erskine Bowles helped to negotiate with the Republicans, that was 50-50. $1 revenue, $1 of spending. In this case, it was 3-to-1. $1 revenues, $3 of spending. And here's the grand compromise. This is a grand compromise that the Commission, 11 out of the 18, proposed. That the Democrats would agree to do entitlement reform, save money. Republicans would agree to do tax reform to create revenues. Not by raising tax rates, but actually by doing a little bit like what we did in '86. When we broadened the base, reduced sort of deductions, credits, tax breaks, and we're able to lower the rates while we broadened the base. And that's really what they proposed. And you know, we call them tax expenditures. I don't know what you call them, but we call them tax expenditures. And I asked Ken Conrad long ago, when you add up all the tax expenditures over the next 15 years, how much, over the next 10 years, how much does it add up to, Ken? He said it adds up to $15 trillion. He said, you're kidding. He said, no. He said, it's $15 trillion. He said, that's a lot of tax expenditures. And he said, there's actually more money in tax expenditures that will, if you will, take out of Treasury and spend. But he said, that's more than we're going to appropriate in all the appropriation bills over the next 10 years. He said, it's a lot of money. He said, what the Deficit Commission suggested is we reduce tax expenditures by, I think, close to half, maybe not quite that much. But that, and do some things that frankly would be hard to do. Maybe not that popular, but they felt they had some obligation to give us some specifics. And there was something in there for all of us not to like. But they also said that we ought to overhaul our entitlements. And give you a couple of quick examples on Social Security. In 1983, I was sworn in as a congressman on January 3rd, '83. And they told us a couple of things that day. One of the things they told us that day was where our office was. They told us where the restrooms were. And they told us how soon we get into our offices. And how much we get paid. And they also mentioned that day, they said, by the way, Social Security is running out of money. And we said, like when? 10, 20, 30 years? They said, no, this year. And we said, you mean they're going to reduce the payments this year? They said, no, they're going to stop paying Social Security this year, entirely. We're going to run out of money. So you're kidding. No, we're not kidding. Unfortunately, Greenspan again headed up a Blue Ribbon Commission, you may recall, in '92 with people like Bob Dole and Daniel Patrick Moynihan. They worked throughout '82 to come up with a sort of a bipartisan, nonpartisan plan to save Social Security, at least for a while. And there was a combination of benefit cuts and revenue increases. And they worked it hard, had hearings all over the country, and God bless him, Ronald Reagan bought into it, and God bless him, Tip O'Neill bought into it. Democratic Speaker of the House, Republican President, who in secrecy were friends. Not supposed to know. But that's the way people actually were friends then. And they liked each other and would get together and have a sarsaparilla after work. But anyway, Democrats were loath to do anything in voting for Social Security at the time because we didn't want to do benefits. The Republicans were reluctant to do anything at the time because it increased revenues. And Ronald Reagan gave, I call it air cover, not to the Republicans, but to the Democrats. And he said, any Republican that denounces or attacks a Democrat for supporting this, I will disown you. That's what he said. He said, we will disown you. Tip O'Neill gave cover not to the Democrats, but to the Republicans. And he said, any Democrat that attacks a Republican for supporting this in the House or Senate, I'll disown you, we'll disown you. And we all drank the Kool-Aid, passed it, and became the law of the land. And Social Security is still around, and we'll start reducing the benefit payments by probably the mid-30s, until 2030. We're not going to eliminate them, but essentially put it on a safer, sounder footing for at least half a century. We have the opportunity to do the same thing for about 3/4 of a century for Social Security. And here's what the Deficit Commission suggested. Take Social Security, full retirement age goes from 67 today by 2050 to 68. Full retirement age goes to, in 2075 to 69. We move away from the current CPI. You know, if you're on Social Security, you get a CPI bump in January, your Social Security check. It mirrors whatever this rate of inflation was in the previous year. The market basket of goods and services that we currently use don't really, I think, accurately measure the cost of goods and services that are being purchased by people in their 70s, 80s, and 90s. And there's something called a change CPI that is believed to be a little bit better gauge than that. And so this recommendation was, let's go to change CPI. It has it reduces a CPI by about 25 basis points by about 1/4 percentage point. It also has some actually positive effects on the spending side as well. I won't get into that. So that was the second thing. Third thing they said is we got most state and local public employees paying the Social Security. About 1 out of every 5 does not. Let's make sure they pay. And the fourth thing they said, the cap on Social Security right now is income cap, $106,000, anything over that. We don't pay the FICA taxes. Let's start to raise that rate a little more aggressively. So that was what they proposed. And there's enough in there for Democrats and Republicans not to like. Here's, but that's what they suggested. They said on Medicare, but a number of changes on Medicare, on Medicaid as well. Democrats have to, we shouldn't be unmindful of the concern for people on Medicare and on Social Security, on Medicaid today. If we want to save these problems for the future, for our kids, for our grandchildren, let's keep that in mind as well. And that should be part of our goal, a big part of our goal. And I think the Deficit Commission gave us a pretty good roadmap. They gave us their recommendations last November. The President gave his State of the Union address in January. Didn't really mention much, the Deficit Commission. Gave us his budget in February of this year. Didn't really mention much, the Deficit Commission. And we got into the back and forth on the defaulting and the government coming down back in the end of July. And there's a group of us kind of came together, Democrats and Republicans, about 25 of us, equally divided, and said, we ought to go back to the Deficit Commission. That's what we should do. In fact, this is what we should have done all along. And we gathered, I remember we gathered one morning in the Capitol of the, down in the room called S-115, right under the Senate chamber. And 25 of us signed the dotted line, signed a letter to our leadership, to the President, and said, let's go big. Let's do the Deficit Commission recommendations. And we'll leave it for the next year to work out the details on tax, the tax code. It's going to take a while. That's what we suggested. And instead, you know what we got instead? Instead of product, a really good product, I thought, we got process. And the process we got was super committee, which I thought at the time was lunacy. I remember sitting, Harry Reid, our leader, right after I left the meeting with 25 senators who signed on the line, he went up to our leadership meeting at 9 o'clock, and he told us how he and Mitch McConnell had worked out this idea of the super committee. And I really thought, and I told him, I was really, really, really unhappy. And the Vice President, I'm a pretty quiet guy, calm guy, but I wasn't that morning. And about noontime, 12:30, I'm at a caucus lunch. In fact, Joe Biden calls me, the Vice President calls me in a caucus lunch, talks to me on my cell phone. I walk out and he talks to me for about half an hour, trying to calm me down, no luck. And I'm on my train going home that night, and who calls me on my cell phone? The President, to try to calm me down. And I, you know, you're supposed to be respectful of the President. I don't care who's the President, I always am. But I said, look, you had a chance, your commission, you had a chance to endorse their recommendations when they made it, when you gave your State of the Union, when you gave your budget address, and you finally did not kind of sort of left-handed endorsement. We actually went beyond their recommendations with your negotiations with Speaker Boehner. But what took so long? And we had a back and forth, and it was not a pleasant conversation, but it was heartfelt, and maybe someday he'll get over it. But here we are. Here we are. We have a super committee, and they're actually good people for the most part on the super committee. And the issue really comes back to Democrats are ready to deal on entitlement reform. Not all of them. Some people don't want to do it. But whenever I say we ought to do the Deficit Commission report, I get attacked by all these left-wing blogs. But we need to do it. And whenever the Republicans stand up and say, whether it's Tom Coburn or Mike Crapo from Idaho or our friend Toomey up in PA, who's at least suggested that there should be some revenues on the table. Not a trillion or not a $500 billion, but at least some revenues. He's had his head handed to him a little bit. But that's really what we need to do. And Chris is coming up. He'll be here, I think, fairly soon. But The subcommittee's meeting today. They'll be meeting throughout the weekend. Their job is to try to give us something by Monday, or at least give to CBO on Monday what their recommendations are. And if they don't, if they just basically throw their hands up in the air, we face the specter of sequestration, which would be another, on top of the deficit cuts that are already adopted 3-4 months ago when we were on the verge of default. We have to do another $600 billion in defense cuts, another $600 billion in domestic spending, which I don't think is very smart. I don't think it's very smart. When actually there's plenty of low-hanging fruit on the ground actually for Medicare and Medicaid. There's some things, I think, reasonable reforms to make in Social Security as well. And frankly, there's some revenues to raise. There's some actually revenues that are owed, not being collected, called tax gap. And there's some revenues that, well, frankly, we could, I think, ought to be able to agree on some of this stuff. And in any event, that's kind of where we are. Deficit, as of like an hour ago when I got my last update, was the Supercommittee's meeting today. We're not seeing a whole lot of progress today. But a good thing's going to happen over the weekend. And one of the things that happen, you spend, a colleague, if you have a chance to spend enough time with your colleagues, you actually get a little closer, and there's a sense of trust that develops. It happened with the Deficit Commission. And you have people who would, most like Coburn, Oklahoma, Republican, wild and crazy guy, the guy who's been really heroic on raising revenues. And you got Dick Durbin, big progressive liberal Democrat from Illinois, who's here's a guy who's the champion for entitlement program reform. And they developed a sense of trust and understanding and respect for one another. I don't think the super committee's had enough time together to be able to do that, but they're going to be together this weekend, today, tomorrow, next day. And my hope is that some of the questioning and doubt and lack of trust and mistrust will begin to evaporate as we get closer to the deadline, and we'll see what happens. I'm not without hope, but I'm not Pollyannish on this one either. And I'll close with this. Sometimes we don't get second chances in life, but in this case, I think we have a second chance. And the second chance is to go back and try to do now what we should have done earlier this year with a comprehensive, bipartisan, everything on the table, grand bargain kind of deal where we actually generate some revenue. We do it while lowering taxes. We move maybe toward a territorial tax system abroad and get some companies to bring some of their money home and spend it here rather than leave it parked overseas. So we'll see where we end up. But Chris will be here in a little bit. He can tell us maybe the latest. But thank you for allowing me to impersonate Maya MacGuineas. And it's been a pleasure. P.S. Well, when I was governor, I used to get to speak at the University of Delaware graduation. And my job at the University of Delaware, there's the middle, anybody who went to graduation at the football stadium out there, beautiful, it's great. And I would get to usually follow the keynote speaker. And my job was to present a pen and pencil set to the top undergraduates, like the 4.0s, and we'd call them forth, and I'd say, you know, this student, they could have accepted all expenses paid vacation to Jamaica. They could have accepted like a timeshare in wherever, Hawaii, and they were offered these options, and instead they have chosen to say, take the value of those gifts and put them back in the university. I want a pen and pencil set from them. So I call them up, and I give them the pen and pencil set. There's one year. The person that was there, the keynote speaker for the University of Delaware graduation at the football field, 25, 30,000 people. Hi, Chris. I'm about to turn it over to you. Anyway, the person was Maya, not MacGuineas, but Maya Angelou. And she told the graduates that day, she said, for my commencement address to all of you here at the University of Delaware, I have written and I will sing this poem. And she did. Beautiful, beautiful lyrics, beautiful voice. When she finished the poem singing and all, the place went wild. I've been to a lot of football games there. Nothing would have compared to the reaction to her that day. And then when she finished, the president of the University of Delaware said, and now Governor Tom Carper will present a pen and pencil set. to the outstanding graduates, undergraduates at this year's graduating class. And I thought, what will I do? What will I do here? So I walked up to the microphone and I said, like Maya Angelou, I too will sing my remarks. And it brought down the stadium. And it gave me a chance to present my pen and pencil sets and go on to tell about it to all of you. Let me just, Chris, you want to sit there for a second, catch your breath? Let me just take maybe a comment or question or two, and then we'll yield to Senator Chris Coons. Can you give me comments? You don't have to ask a question. Sometimes people ask questions, but all they just want to say something. So just want to say something, that would be fine. This gentleman right up here.
Is there any truth to the rumor that the super committee is going to take an active role in estate tax reform and kill the $5 million exemption?
No. No truth. No truth. Next question. I don't think they're going to get into the specifics along those lines here. George Widener and I once proposed a compromise on estate tax reform. What we suggested, we need some certainty, we need predictability. I think, well, I just come from speaking to a business group up in Philly, and one of the things we really need, I think the best jobs bill that we could put in place would be something along the lines that we've talked about for deficit reduction. But there's, first of all, a question, can we govern? And then there's this huge uncertainty, lack of predictability. Responsible fiscal policy for our country, what is our tax policy going to look like? What's going to happen on health care in terms of if it's constitutional or not? We need some predictability, we need some certainty. And for myself, what George and I said, George Voinovich, former Ohio governor, former senator, what we suggested is that we go back to where we were in 2008, kind of frozen place. I think it was $3 million or something like that, $3.5 million for both spouses, and for a total of $7 million. And the tax rate that would apply for everything above that was, I think, 55%. And I think that there's probably a compromise somewhere along this way. And if we're smart, we'll find it. We can't, we're in the wrong business. Thank you. Yes, please.
You gave a couple of examples of people going across the aisle to solve major financial problems and successfully doing that. And you started off by asking if, can we govern now, is the question of the moment. And I guess I'm wondering, from when you first arrived in Washington to now, do you find that the place is noticeably different in terms of the ability of the parties to work together? And if it is, what's changed? What caused the change?
That's a great question. A couple of things have changed. One, in Delaware we have 1 congressional seat. In California they have 53. And until very recently, until actually the last year or so, in California, most other states that have more than 1 congressional seat, if they have a seat that looks like it could be a Democratic seat, they do whoever's designing the seat does their best to make sure that stays a Democratic seat. And in that state, if there's a Republican seat, the Republicans want to make sure that stays a Republican seat. What we end up with in a lot of places, not every place, but a lot of places, the Democratic seats, whoever wins the primary tends to be someone who's generally more liberal than not. Not always, but usually. In Republican seats, because this is clearly a Republican seat, a lot of times the activists within that party are the more conservative folks. And not uncommonly, you have the Republican nominee is somebody who's well-right of center. And they win. And they win. And they win across the country. And we end up today with a House of Representatives which has a lot fewer centrists. We had a whole lot of centrists in the House when I was elected in '82, and we don't have that today. And so we elected all these liberal Democrats in the House and all these conservative, very conservative Republicans, put them together and say, okay, play together, work together. It doesn't always work that way. The other thing that's different is our Tea Party friends, there's about 80 or 90 of them in the House. And these are folks who don't take the advice. Whenever I meet people that have been married a long time, I always ask them, what's the key to being married 50, 60, 70 years? I get funny answers, but I also get some great answers. And one of my favorite answers is, I asked this couple, I know they've been married 55 or 60 years. I said, what's the secret for being married 55 or 60 years? And the husband said, the 2 C's. He said, it's the 2 C's. And I said to the wife, what does he mean? She said, communicate and compromise. Communicate and compromise. And there's some folks, particularly the new people, some of the folks on the Tea Party side, and especially in the House, those communicate and compromise, there just aren't words that they're used to using. And I think after they've been there a while, my hope is that they will become more willing to do that. Maybe they will. And we need to do that on our side as well, but I think some of the new people, that's a hard lesson. So those are 2 things. And we have some folks, especially some of the new people, they're willing to bring down the government. They're willing to bring they're willing to default on what they think is principle. And I don't want to question their motives or their principles, but it's rare that I get everything that I want on an issue. It's rare, but there's a guy named Mike Enzi that Chris and I serve with, a guy from Wyoming. And Mike Enzi and Ted Kennedy here's Enzi, third most conservative Republican in the Senate, Wyoming. Here's Ted Kennedy, one of the most liberal Democrats prior to his death in the Senate. And they got incredible work done out of their committee, the Health, Education, Labor, Pensions Committee. I'd say to Crapo, I'd say, not Crapo, to Enzi, I'd say, Mike, I'd say, how do you and Ted Kennedy, I mean, you come from different universes in terms of politics, and you get so much done. Enzi said this. He said, Ted and I agree on 80% of the stuff. We disagree on 20% of the stuff. And what we decided to do is focus on the 80% that we agree on and work there, and the other 20% that we don't agree on, we set it aside for another day. That's the 80-20 rule, and frankly, we'd all do well, particularly where I work, to subscribe to that. With that having been said, ladies and gentlemen, a warm welcome to our Senator, Chris Coons. Chris Coons.
Can everyone hear me if I just talk loudly?
What do you think?
Happy Friday afternoon. Fresh from presiding over the floor of the United States Senate for 3 hours, I am struggling to remain awake, so forgive me. I appreciate the opportunity to be with you, and frankly, I'm very interested in your questions, more even than in my comment. I've just finished my first year as a senator. I serve on the Foreign Relations, Energy, Judiciary, and Budget committees. Some of you know me, but many of you may not. I spent 8 years as in-house counsel to a materials-based science company, headquartered in Newark, Delaware, about a $2.5 billion in sales company, about 10,000 associates, in about 45 manufacturing facilities worldwide, and was exposed to some of the pricing and transfer tax and regulatory compliance issues that challenge multinationals in that environment. I spent 4 years as head of our county legislative body, and then 6 years as the countywide elected county executive here. If there's folks from other areas in the region, that's a less familiar structure. It's really more like a mayor or a governor than any of our surrounding states have. And for the last year, I've had the joy of serving in the United States Senate as the understudy to this talented senior senator, someone who 10 years into it seems as excited about it today as he did his first day. I only hope to emulate that level of tirelessness and energy. I keep telling myself that I've come into the second act of a 4-act play, that I shouldn't be incredibly frustrated and banging my head on the table every day at the division, the lack of progress, the unwillingness to listen to each other. That part of the story is that the 111th Congress, the one immediately preceding the current, was in many ways the farthest reaching, most active, some might say most aggressive, in its legislative scope and its regulatory ambition of any Congress in the last 70 years. And so the fact that I spent just 6 weeks in the 111th in the so-called lame duck session, in which I was seated immediately following the election because I'm filling out the last 4 years of former Senator Biden's term. That was a rock'em sock'em robots 6 weeks with a whole lot of, I would suggest, hastily assembled and not very well thought out tax policy jammed through right at the end. Following that, we've had a much more quiet, much more languid, much slower time, where frankly the 80 hours that I have so far presided over the Senate as the geographically closest senator, freshman senator, I get the joy of presiding Monday afternoons and Friday mornings, during which the cave of winds is utterly still. If wind power is to predict its future by what's going on in the Senate, it is really not going to be a sustainable source of energy. We typically have one senator at a time out there, speaking more than not to the cameras, occasionally surprised when they see me paying attention and taking notes. In fact, a number of my Republican colleagues have come up afterwards and said, "Thank you, that's the first time in months anyone's actually listened while I was speaking." And one of the real challenges we face, to a question you asked of Senator Carper, we need more bridge builders. One of the things that really distinguishes Tom Carper from many of my colleagues of both parties is his persistent enthusiasm for building personal relationships with people on both sides of the aisle. One of the more sharp-elbowed Tea Party freshmen the other day commented to me that I serve with literally the nicest guy in the Senate. He sends handwritten personal happy birthday notes to every senator. He remembers their spouses' names. He asks after their children. He even holds the door for them. I mean, he is one nice guy. At the end of the day, I think that is what's going to be required to weave back together the somewhat rent fabric of the United States Senate, which, because it is small, because it was designed to be clubby, because the rules allow anyone who gets cranky and has a wild hair to shut the whole thing down for days on end. We have to get back to a place where everybody perceives themselves as having some real stake in legislating. And really the core dynamic that we're struggling with now, which the senior senator identified, is that we have a hardened group, not very large, maybe as many as 6, who really believe that the failure of the body to act is success. And using the power of the filibuster, using the power to put holds on nominations and on bills, using the power to procedurally shut down the Senate, which really more than not operates by what's called UC, or unanimous consent. They have ground down the process to where we can barely get through nominations. We are in, I believe, the 3rd year of the Obama administration. I mean, in 2009, 2010, 2011. We're in November of 2011. Some of the most senior positions in the administration are only just now getting filled. We have 19 judges, judicial candidates, who passed through the Judiciary Committee unanimously. So we've got Mike Lee on the Judiciary Committee. He is one of the most conservative Tea Party members. If you've got 19 judges who made it through the Judiciary Committee unanimously, that means there's no objection. These are qualified judges who have no ideological issues that sticks out left or right. And yet we cannot get floor time for their consideration, for them to be seated. Here in the District of Delaware, in the last 5 years, we have not had a full bench. We have just in the last 2 weeks finally gotten Rich Andrews, thanks to the senior senator's tireless advocacy and my willingness to chair a nominating hearing. We finally managed to get Rich, now soon to be Judge Andrews, seated on the Delaware District Court in a full complement. Why does that matter? Because a lot of business comes through Delaware, as we believe it should, both because we have an outstanding chancery court and because we have a strong district court. And if there is a very large backlog of patent matters, of criminal matters, it's difficult for the business of Delaware to move forward on courts. Let me talk for a minute, if I could, about the budget process or lack thereof, about the super committee, and then answer your question. I was, to be blunt, embarrassed as a member of the Senate Budget Committee that we never got a budget out. And I have to sit there and listen to my friend. You know, when other senators used to say that years ago, I never believed them. My friend Jeff Sessions of Alabama, the senior Republican on the Budget Committee, who I actually have gotten to know and genuinely like through, we have a prayer breakfast every Wednesday. He works out in the gym regularly, I would even say religiously. And he is personally a very engaging guy. He is very ideological and he's fairly aggressive, but he's personally a fairly charming guy. And every day he comes to the floor and says, it has been fill-in-the-blank days that the Democrats have not proposed a budget. And shame on them. I think we're at 897 or something. Paul Ryan, who was the chair of the House Budget Committee, put out a budget. It got a lot of grief. It was attacked mercilessly by my party. In case you don't know this, I happen to be a Democrat. My party happened to, and I think with good reason, attack his plan for being overly aggressive on entitlement reform, fundamentally restructuring some of the elements of Medicare, and achieving significant rate reductions and tax reforms, but in a way where a majority of those funds were not used for deficit reduction. In fact, he had a budget plan that did not make significant progress in reducing the federal debt. But you know what? I don't feel like I've got a leg to stand on in criticizing him because we didn't get one out of my committee. It was an interesting, in fact frustrating exercise. As the budget chairman, a very senior, very talented man who is very interested in the intricacies of federal budgeting and in particular tax policy, struggled mightily to assemble a bipartisan coalition and thought up until the last weeks that we had 2 Republican senators willing to join the more conservative or moderate Democrats in a package that looked a lot like Bowles-Simpson. You've heard a lot, I suspect, about the Bowles-Simpson Commission, a bipartisan commission that spent a year coming up with 100 pages of, I think, fairly thoughtful, tough, bold, broad, bipartisan proposals for how to trim $4 trillion, how to achieve $4 trillion in savings over the next decade, which every economist who came in front of our committee agreed was the minimum necessary to stabilize the national debt and to really get a handle on the deficit, and in my view, contribute to our economic vitality and our national security. When one, then two of the Republicans on the committee decided they were not going to join the more moderate Democrats, then we had to wheel, frankly, to the left and reassemble a whole budget that was able to command the support of, I'm not kidding, from Bernie Sanders to Mark Warner, from literally the one socialist in the body to a guy who was a corporate CEO, who are all on the same budget committee and have to all sign off in order to get it out. We actually never got there. We didn't get a budget that leadership was willing to endorse our putting out, because by then we'd gotten to a point where we were fighting over possibly defaulting on America's mortgage on the debt ceiling deal. So the super committee was born out of the conflict of August. I did not think we should have defaulted on America's debt. I'd be interested in debating with anyone who thinks we should have. And I was struck at just how hard some folks were willing to negotiate in a game of chicken that went right up to the last minute, and I think put our sovereign rate at risk. Out of that came the commitment to this structure of folks from the House and Senate, both parties, who have unusual powers, unusual magical powers, to take an expedited bill and get it straight to the floor. Most of the frustration I talked about earlier is because of the filibuster. The filibuster in the hands of the minority can be used to largely shut down, or at least significantly slow, action on the floor. The super committee has the ability, if a majority, simple majority passes it, so one defection from one party to the other allows a simple majority proposal to go right to the floor, no amendments, guaranteed up or down vote. This unusual structure, which I believe has never been done before in a budget setting, really only the base closure process, the base realignment commission has had a similar empowerment structure. I think we will discover that they will utterly waste this opportunity. I hope not. I've noticed in my 1 year that everything big gets done on the last afternoon, of the last minute, of the last hour, of the last day. Some of you remember in March when we came 15 minutes away from shutting down the federal government. I was presiding at the time at 11:45 p.m. And had the joy of getting a Facebook message from a Delawarean whose husband is flying medevac missions in Afghanistan, who essentially said, and it was not this polite, "Shame on you, how dare you come this close to making my husband who's risking his life for our country, worried that his wife and children might not get their check next week. Can't you all grow up?" This was from a friend. So I feel the opprobrium. I'll tell you that in recent surveys, tax lawyers are 3 times as popular as members of Congress. In fact, in the most recent survey, the IRS has a 40% approval rate. Hugo Chavez and communism have a higher approval rate than Congress today. As Senator McCain said on the floor, that means we're down to blood relatives and paid staff. The only people who will admit to liking us in any way. The challenge then is, how do we behave in response to that? I have a simple answer. There's a freshman senator from Florida named Marco Rubio. Some of you may have heard of him. Marco's a Tea Party conservative. He, like me, was by some not seen as the obvious likely winner of his campaign when he got in. He was somewhat of a long shot. He is a young, energetic, very conservative senator from Florida. And we happen to have an attorney friend in common, in Adrian Arsh. You may have heard of Morris Nichols Arsh in Tunnel, or Arsh Hall, his parents. His mother was the first woman judge and a very talented community leader, as was her father. She went to the same high school in Delaware I did. We've gotten to know each other in the last couple of years. She later moved to Miami, where she ran a bank and was a significant philanthropist. The day after the election, she apparently called and emailed both Marco and me and said, "You need to get this other fellow. You need to meet this other fellow and get to know him. He's a good guy, you can work together." I was stunned. And she has haunted me on that point in the last couple of months. And so on a few occasions at the prayer breakfast, we sat next to each other, once working out in the gym, we talked to each other. Our staff had managed to be together at different events. And eventually, we found ourselves sort of stuck in one of these vote-a-rama nights where we had 15 amendments. We started at 9 p.m., we finished at 1:30 in the morning. And we were both really grumpy off the floor. And he said, arms crossed, "The next election will solve all this." And I said, "Really? Really?" you think the next election is going to solve all this. You're not going to get 60 votes, and neither are we. This was the closest any party's ever come in the last 50 years to having, right, the White House, the House, the Senate, and the Democrats for a brief shining moment, who knows if it was shining, for a brief moment, had 60 votes, and then bam, the American people took back the wheel and said, you guys got to work together. I said, I think the 2012 election is going to be a chip shot, one way or the other. Either the president's reelected or it's Romney, either we hang on to the Senate by 1 or 2 votes, or you get it by 1 or 2 votes, but it isn't going to be a trifecta, because the American people want us to work together. They want us to find principled compromise. And he kind of chewed on that for a while. And he said, have you ever read Romney's jobs plan? I said, I didn't know he had one. I said, have you read the president's jobs plans? Well, not exactly. I said, how about we challenge each other and our folks, and we trade prisoners? And we take the President's Council on Jobs and Competitiveness, we take the President's Jobs Act, and we take whatever we can find from Kane and the proposals from Romney, and we put it all in a big pile, and we sift, and we sift, and we sift. And let's see what's left. And if you and I can come up with 4, 5, or 6 proposals that we can put our names to and agree on, I think that in and of itself might bring some optimism or confidence to small business owners, to, I don't know, tax planners, to people who are wondering about the future of this country, because right now the fact that none of us can agree on what day it is I think, a significant drag in the economy. So 2 days ago we introduced the AGREE Act. Don't you love how we have acronyms for everything? The American Growth, Recovery, Entrepreneurship, and Empowerment Act of 2011, which happens to include 3 tax provisions. 3 are simply continuations of current tax policy, which I like. There is a capital gains exclusion for 5-year holding of investments in qualified small firms, A. B. There is accelerated depreciation, 1-year depreciation for qualified small businesses. 3, I think it's section 179, expensing. It continues the current higher expensing limits. And then 4, this is my favorite because it's actually an idea that I've been interested in for a long time. Changing the R&D tax credit to make it, I know this is expensive, but permanent, expanded, and tradable. What do I mean? The R&D tax credit is not accessible for smaller startup companies that aren't yet profitable, right? And that's exactly the area that we most want to incentivize. And second, I want to add an incentive if you make here what you invent here. Because across the country, over and over, I hear from folks that the sentence they most want to hear is invented in America, manufactured in America. We're interested in invented in Delaware, manufactured in Delaware, but we'll take America. And there is, I think, a broadly shared concern that in the absence of fighting for manufacturing and fighting for innovation, we're not going to have much to fight over in the future. So anyway, there's some other provisions that have to do with intellectual property, with veterans employment, with immigration, with Sarbanes-Oxley relief for companies that are below 250 in revenue for their first 5 years. Yeah, I thought someone might be interested in that. But it is a grab bag of things that are other people's ideas, where we recognize that other folks have hammered them out, but where we simply wanted to put on the table the prospect that conservative Republican and moderate Democrat could actually find ideas on which they agree. I hope you find some small modicum of encouragement in that. I cannot predict for you what the super committee will do. Senator Carper has much better insight than I do. But I can tell you that, at least speaking for myself, I'm sorry you didn't get to hear from Maya MacGuineas today. She is very bright, very determined, very engaged, and the most optimistic moments I've had in a year in Congress have been when the Gang of 6 first sort of opened up the doors and invited other senators and asked for all comers. We had a moment in S-115 that was like a prayer revival. I mean, it was remarkable. We had more than 50 senators, Republicans and Democrats, those who've already announced their retirements and those who are at the beginning of their careers, standing up and saying together, we have to get over the refusal to talk about the big issues, a willingness to make tax reform that will broaden the base and raise revenue by lowering rates, and we have to, my party, be willing to talk seriously about entitlement reform that strengthens and sustains entitlement programs for the next generation of beneficiaries, but recognizes the need to bend the cost growth curve. If we get both of those on the table, we ought to be able to make progress as a country. The one thing I find optimistic about the developments in the super committee of the last week is it is alleged that in private meetings, Republicans said new tax revenue and didn't blow up. And Democrats said trim costs from entitlements and didn't fly away. And everybody's still in the room and nobody's dead yet. And that is, well, I got to tell you, over every other major negotiation, whether it was Biden-Cantor or Obama-Boehner, or it was the efforts of the Gang of Six, or it was, we have not had a moment where publicly leaders of both parties recognize that's our core problem. We can't wait for an election to solve them. We need to make progress. I hope this was in some way useful, relevant, or helpful, and I welcome a couple of questions.
We're actually already past the time of the function and on our break time.
Sorry.
But are there any questions that you would have of the senator?
That's called a filibuster in my mind. Sorry, what's the name?
What's Congress doing about bringing jobs back to the United States so we can have productive money spent here?
What a great question. There's a couple of things you could mean about that. There's a whole range of initiatives in my view. Immigration, trade, intellectual property, public education reform that's relevant to that question that I'd be happy to talk to you if you want. I suspect you may be interested in repatriation specifically. There are two different proposals currently in the water on a 2 to 3 year repatriation holiday. I looked hard at joining the one that McCain and Kay Hagan had introduced. It has some clawback provisions in terms of increased W-2s, and there's a little detail in there I'd be happy to talk to you if you want it. Frankly, I am more inclined to favor a Schumer effort where the net new revenue through repatriation is dedicated to an infrastructure bank, and we don't try and put restrictions on how the return funds are used by companies, because I think that with the fungibility of funds, it's going to be difficult to ever actually demonstrate it, and given the very, very vigorous opposition to a repatriation holiday by both the Chairman of Armed Services and the Chairman of the Budget Committee, who lambasted me on this point just on Thursday for a happy report. It will be difficult if you pass something where part of the justification is, oh, and there's going to be increased hiring on it. There will then be hearings to rake over the coals companies as to whether they were sufficient in hiring. So I think it's actually a cleaner approach to say, repatriate at a lower rate, and the new tax revenue will be invested in an infrastructure bank. In my view, that's a proposal that gets something that some of the major multinationals want, and that the AFL-CIO and folks who work in the building trades want, and that's the kind of marriage we may need to make things move at this point. Was that your question?
Thank you.
Sir. This is your break.
All right.
Happy to take one last question. How much of a joy is it working with Tom Carper? Thank you for asking.